This is the BiggerPockets podcast, show 383.
You're listening to BiggerPockets Radio, simplifying real estate for investors large and small. If you're here looking to learn about real estate investing without all the hype, you're in the right place. Stay tuned and be sure to join the millions of others who have benefited from BiggerPockets.com, your home for real estate investing online.
What's going on, everyone? It's Brandon Turner, host of the BiggerPockets podcast, here with a very cool, different type of show and a very long show, here with my good friend and co-host, Mr. David Green. David Green, how's it going, man?
It's going great. We just had Mother's Day yesterday. Got to go see my mom and have dinner with her. Had a good day. Did you guys celebrate with Heather?
No, we don't celebrate Mother's Day. I think it's a card Hallmark factory holiday, and we don't believe in supporting big business. So,
well, frankly, I think mothers get way too much credit as it is in society. We are
I agree.
way we just cater to them so much, and we're way too appreciative.
I know, so much. I mean, what did they really do? I mean, really, like.
That's exactly what I'm saying. I mean, do we really need moms at all? I think we'd be fine if we didn't have them. Yeah, I agree.
There's like 12 people who just like are so angry right now because they don't read sarcasm. Yes, Mom, I love you. I love everybody who is a mom, and you guys are awesome.
You guys are the real MVPs for sure.
The real MVPs. But of course, that happened like a week and a half ago after this episode came out, because last week we released an episode we wanted to put out right away with Josiah Smelzer. So Josiah was a good buddy of mine who walked through his journey of the difficulties he went through and how he overcame them on his small, I would say small because of what we're about to talk about, but on his like single family deals, right? It's single family houses. Today, we're going to do the exact kind of same concept as how is COVID affecting the world, but we're doing a two-part podcast episode with Sam Grooms and Ben Leybovich. So Ben's been on the show a number of times before, and Sam, this is his first time. So they actually, we recorded the first half of this just before the whole social distancing thing came down, and we did it like here in my my shed here out in Maui when Sam and Ben were visiting. So we talked about what they're doing. We talked about a lot of really, really great topics, things like how to look at equity versus cash flow, some stuff about partnerships, choosing a market, how they manage risk for their big syndication deals, things like that. So we had a great topic. But then, of course, the world's changed in the past couple months since we recorded that. So here's the deal. Rather than a whole separate episode, we are going to tag on an extra 45 minutes at the end of today's episode. That is a follow-up that we just recorded just a few minutes ago here the day after Mother's Day. And we put them all together. So you can listen to the first half, hear all about their story, their journey, and then you can listen to the second, what they've done since then, what's gone right, what's gone wrong, what's changed in the world of real estate. Really good stuff. We talked about some really high-level stuff. You guys might, if you're new to real estate, you might not understand every word we talk about today, both in the first and the second, because, they're very smart dudes, but just, it's very high level. If you have any questions, you can always go to biggerpockets.com/glossary or jump into the show notes and ask questions there of Ben, of Sam, of us at biggerpockets.com/show 383. But now, before we get to the show, the super long episode today, let's get to today's quick tip. Did you know that BiggerPockets has an official Facebook group? Now, there's been a number of unofficial ones and people like fan groups over the years on Facebook, but we have officially started an official Facebook group officially. How's that for being official? And you can get to it by just going to your Facebook page and search for, BiggerPockets Official, and you should find it there. There's also a group for the Rookie Show, and I think there's a group for the Money Show as well. And so, but there's a official real estate Facebook group now for BiggerPockets. So just make sure you type the word official in there and you'll find it. And we'd love to have you in the group. It's just a great place to connect and talk and chat and ask questions and celebrate your victories. So check it out. Again, go to Facebook, search for BiggerPockets Official, and you should be able to find it there. So I think we're pretty much ready to get to today's show. Anything you want to say before we get into it, David Green?
One of my favorite parts of this whole before and after, or maybe before and during thing that we're doing, is that you get to actually hear all the fears and the speculation people had, and then fast forward in your time machine 2 months and see how much of that came true. And I love that because we forget about all of the declarations that people made that were really dramatic in one direction or another. Like 6 months later, we don't always look back and see, I guarantee victory, and then they get smashed. And so This is a pretty cool way of seeing all the fears everyone had, all the concerns, all the speculation, and then zip forward and see what actually happened and seeing how much of that came true. And the more of that you sort of experience as an investor going through this journey, the better of a detector that you'll start to develop for when you should be worried, when you shouldn't be, and more importantly, what you should do to mitigate that risk rather than letting it freeze you into not taking action.
All right. Welcome to the Bigger Pockets podcast, gentlemen. Good to have you here. Sam, Ben, what's up, guys?
Not much. Beautiful view out here.
It's not too bad. I get to stare at Ryan this whole time.
Thanks for having us.
That's what you meant, right? Right. That's what I thought. All right. Well, we want to go through your story today, each of you. Ben, you've been on the show before. Ben's been on the show many times before. Sam, this is your first time. And so why don't we start with Ben, get your 30-second story. Ben has an ability to make 30 seconds into 30 minutes, but we're going to get your story. And we're going to go to Sam. Ben, go. All right, Sam. So tell us about, okay, what you got?
I got diagnosed with MS when I was in college. I needed to figure something out to make money. I didn't have a lot of cash, so I couldn't invest in dividend stocks. I wasn't smart enough to build a business. So just like any Dumbo, I went into real estate, and there you have it.
All right. Wow. And you bought a lot.
Story.
You bought a lot in Ohio.
Well, not a lot, but yeah.
Like
I've been doing it since 2006.
But you kind of made a large change in that you started with the smaller stuff, and now you don't even touch the smaller stuff.
Correct.
And so we'll talk about that today again a little bit more. But Sam, your story. So how did you get into this thing?
We want a short or long version?
Let's go a minute long version.
So I was a CPA, worked at Deloitte. They're one of the largest financial services companies in the country, or actually in the world. In 2014, I bought a house with my wife. We started renovating the house. I did everything from electrical, the plans, got the permits, and refinanced, pulled out a bunch of money, got rid of my PMI, and decided I loved real estate. So started doing that on the side, started flipping, started investing in multifamily syndications. And then that's when I met Ben and decided I wanted to sponsor multifamily syndications, and the rest is history.
That's where we're at today. All right. So I want to start a little bit with the transition from your full-time job and that hustle that you had. So Sam, tell us about when did you know it was time to leave your job? Why did you leave the job? And kind of walk, because a lot of our listeners right now are at that point where they're like, I hate my job, or I don't like my job. Maybe they like their job, they just want something different. Yep. And they want to transition out. So how did you make that transition?
Interesting question. So right when I started, I got recruited by a new company right after I bought my house. And I figured out in the first month that I could automate a lot of the tasks I was doing. And so I started in the first 6 months, I spent with IT every day. I don't even know if I've told Ben this story. I worked with IT every day to automate a lot of my tasks. And actually half of my day freed up. And so then they gave me a few more tasks, but I don't think fully caught on that I automated most of my day. So I actually just started analyzing deals all day, every day. And that's what I love doing. I spent most of my time doing that. And that allowed me to really learn the market and the local market in Phoenix. And then I realized that I loved looking forward to that time of my day that I can spend doing that. And I wanted to do something I was more passionate about. And yes, I was making great money, climbing the corporate ladder, but I wanted to do something I loved. And we had just gotten married. And my wife and I knew that if we didn't take the leap of faith then, that we wouldn't do it once we had kids. So it was the perfect time for us. And we both quit our jobs at pretty much the same time, about a month apart, and started flipping, and never looked back.
All right. Now, Ben, have you done flipping as well in there? You just
I did a couple
dabbled
just by default because I got hit with the market change last time around. But I want to make a note because I've been in BiggerPockets a long time. I've written a lot. I've done a lot of podcasts. And I think I need to protect my reputation of being honest with people on BiggerPockets. Your question to Sam is a lead-in. A lot of people want to leave their corporate job. A lot of people want to be Sam, frankly. And honestly, what this guy can do with automation, with spreadsheets, with just capacity to read stories in the numbers, very, very few people can do. I remember you asking me, when I first hooked up with Sam, you're like, what about Sam? I mean, how smart? And I remember telling you, Burke, as smart as that, maybe a little smarter in some ways. I mean,
those are big shoes to fill.
I think it's wrong to leave the impression that just because he can do it, you can do it. you can do some way, some shape or form, you know, but you can't, you know, what he has done is ridiculous. I mean, it's just like things that took me 10 years in the trenches to learn, he figured out by looking at financials in 6 months. I mean, it's just nuts.
Yeah, that makes sense. And you had that skill set that you brought into it, which is why I think you were able to scale from, like, I believe most people, not everybody, but a lot of people could probably jump in and flipping houses. David, I'd love to know your thoughts on this too, because you flip houses. You're especially getting more into flipping houses. But like flipping houses is not a impossible skill to learn. Doing large multifamily syndication is a pretty difficult skill to learn. Not impossible. Again, I think if people really want it, they'll find a way. And if not, they'll find an excuse, right? To steal a Jim Rohn quote. See, David, I gave credit to Jim Rohn there. And, well, like, what
the trademark lawyers have targeted Brandon now, and they're circling like hawks ready to swoop in.
No, I've never stole a quote. Jeez, this guy. All right, no, this I am curious. Yeah, okay, I'm gonna go David first. Like, I'm curious, what skill set do you need to quit your job to flip houses? I'm gonna go there first, and then we'll talk about what skill sets you need to do others. So I'll start with you, David, and I know we're not like interviewing you, but
if you want to flip houses, it's basically running a pretty simplistic business. Now, when I say simplistic, I don't mean it's easy. I mean, compared to if you were to buy a brick and mortar institution where you have, you know, like 20 employees that you have to manage, accounts payable and accounts receivable that you have to be looking at, accountants. You have to understand the margins of every single thing you're selling. That's what most businesses are like, and that's very difficult. Like if you wanted to open a shoe store or sold clothing or something. House flipping, there's a lot less variables that go into this thing. There's what am I buying it for? What do I have to do to fix it up? What are my holding costs and what am I selling it for? When there's less inputs, it becomes more simple, but that doesn't mean it's easy. It means anyone can do it. And with a business like that, the most important thing is you have to be able to find leads. If you can find deals and you can fill a bucket up with a bunch of water, which is your equity, then you can make money flipping houses. You'll make less money than the next guy, right? Like someone like Jay Scott's going to be super systemized. He's going to do better than you. But you can still make money if you could get enough equity in that deal. So you have to have the ability to find leads, and often with that comes the ability to negotiate. You have to be able to talk to people and be able to get something under contract and have some skills when it comes to that. Everything else can be hired out. You can hire a contractor to work on your rehabs. You can hire a bookkeeper to keep the books. You can have somebody who actually analyzes it for you. There's Sams out there who, like Sam just said, I would look forward to that part of the day all the time. I loved it. We all have that one part of what we do that makes us come alive, and we love to get in there. You find people that are good at those things, and you can run a house flipping business pretty simplistically compared to what most businesses are like, but you got to be able to find leads. If you're that kind of person that doesn't like to talk to people, doesn't like to put yourself out there, you're afraid of being told no, or you're afraid of having to make, 99 swings before you make contact on that 100th one, you're going to hate house flipping. But when you realize that when you do one good one, how much money you can make, it makes sense when you average it all out.
That makes sense. Anything you guys want to add to that?
For me, it was just from the analyzing so many deals. You're going to get a ton of deals. If you reach out to every wholesaler in your area and just get on all of their lists, you're going to get more deals than most people can look at. Yeah. So you need to be able to look at really quickly and know if it's a deal or not. So when you get that address and the price that they're asking and their ARV, and really quickly know, I know that area. I know what it's going to cost to take to rehab it. I know what I'm going to be able to sell it for. Is this a good deal? You need to be able to do that in less than a minute. And so just the more you can analyze deals, the faster that'll go.
Yeah. It's huge. All right. So let's talk about how you guys met. So you're doing your own thing. Sam, you're doing your own thing. Ben, you're doing your own thing. I know, Ben, last time you were on the show, you were talking a lot about multifamily syndication, and you kind of started, entering the space, but now you're like a syndicator, right? So I want to go through that transition of how that happened. But first, let's start with how you guys met each other. Because, you really took off once you found each other, right?
Right.
All right. So how did that happen? How did you guys...
You tell a story.
So
I'm letting Sam talk.
Yeah,
because he yells at me every time because I talk all the time, right? Prima donna, the professor.
All right, let's hear it.
So as I'm flipping, I started investing in multifamily syndications. All of them were local to Phoenix, all local sponsors. And actually, I'm listening to a webinar that you were putting on, Brandon, and you mentioned a syndication that you're investing in Arizona. And I thought, oh, that's perfect. I'd love to find out more about that. So I emailed you, and you connected Ben and I. And
I should go back and look at that email. I don't remember that. I don't remember that, but I must have. That's good.
Yeah.
Okay. So
and for me, it was a very personal decision, and a lot of it again had to do with Brian, who's telling me for a long time, get out of Lima, get out of Lima. You have no idea what growth looks like. You're sitting in Ohio, get out of Lima, and one day you wake up, you look at stuff in the mirror, and you say, you know what? I bought a duplex, I bought a triplex, I bought a fourplex, I bought a 10. That cup is overfilled, like on a very personal level, right? It was just like, I can't buy another small multifamily. It's just not me anymore, and I didn't know what me was at that point. Just like he outgrew his cubicle, I outgrew my, well, okay, I have 30 doors, I have 40 doors, hoopah. It was done. I was done. Like the guy I was, like looking in the mirror, was not a guy that could tolerate buying another fourplex.
Let me ask you a question on that note. How much of that was that transition? Because again, a lot of people listening to the show right now are investors who have 10, 20, 30, 40 units. How much of that transition was because you just wanted something more, or did you need something more in terms of like financial? Like, because I'm assuming you would have been fine. Just
no, you don't need more financially. You want more financially. What
made you do that?
Is your manhood, your impact on society, your capacity to deliver a lifestyle to your kids. Those are the things we need. Money is a byproduct of growth. And I was just simply in a place personally where I was done, dude. It was a very difficult place. And I like to describe that place, and it happens every time. Like you hit a plateau, and that plateau looks like you're standing in a cornfield in Ohio someplace, and the corn is really tall, and like the top of your forehead is sticking out above the corn and your eyes, and it's dusk. It's not dark yet, but it's like dusk. And all of a sudden you hear church lights, and you start spinning around like this, spinning, looking for the church bells. And you're not nuts because you can hear them, but you can't see the church anywhere. And so you're looking, it's like you're so close yet so far away. And that happens in growth every time. Like it's a hockey stick. You go up and then you hit a plateau. And then that right there, you're spinning around looking, who am I now? Like, what's next? Who is this guy now? Right? And that's the place I was in. I was already successful. I already had cash flow. I already had some equity. I would pay it off. I'd be fine. My kids would be fine.
Yeah.
But that wasn't me anymore. So like, what now? So it's kind of I call it a breakage period, where it just like life really pushes you and just to see what you do, And so it's very personal. It's really all about growth. None of it is about money. Money is nice, but it's growth.
Yeah. What about you, Sam? Why did you make that jump? Like, why not just be satisfied with the flipping or the smaller stuff you were doing?
So I started learning a lot about multifamily, just going to conferences, reading books, listening to podcasts. And I noticed that my skill set related a lot more to multifamily and the financial side that's really involved with multifamily. And I loved the real estate side and flipping and taking something and improving it. And now I just do that on a larger scale with multifamily.
I think something about your guys' story that I really want to highlight for the listeners is the most successful people that Brandon and I talked to had a career growth trajectory very similar to yours. The newbies always say, okay, tell me every single step I'm supposed to take, all 150 of them. Let me line up my dominoes as perfectly as I can so I never make a mistake. And they spend 17 years trying to do that. And then they realize that real estate has tripled in value and they haven't done anything. And they're in the same place they were. The people who are successful say, I can see the first step. Let me go take it. And then like Ben, they go build up a portfolio of small multifamily properties. They learn the fundamentals of real estate. They learn how to manage money coming in and out. They learn how to keep books. They learn tenant laws. They just learn the basics. And so there's some confidence. And then they say, yeah, I don't really think I really like doing this anymore. What would I rather do? Then they find something else. And then they go do that. And it ultimately accumulates in you ending up where you should have been because like, this is going to sound cheesy, but your heart kind of guides you, right? I don't like doing this. Sam knows his heart says, I want to be analyzing stuff. When you put an Excel spreadsheet in my hand, I feel like John Wick with a Glock. This is how I like to feel. And he knows that's where he's supposed to be. You don't know that before you start. You don't know what you're going to like how you should be doing it. You have to get out there and start doing stuff. And it's okay that you change course. Like the stuff Ben learned doing small multifamily is the same
fundamentals he's using doing large multifamily is just kind of on steroids now. But that's okay, because you have to learn how to do addition before you can learn how to do multiplication. If you wait until I want to learn algebra as the very first form of math that I ever learn, most people will never actually end up learning anything. And so this path of real estate, of charging forward, hitting a ceiling, and then picking a new path to go, is what your path really should look like.
Absolutely. And it doesn't have anything to do with real estate. I mean, it's just personal growth, you know. In the middle of it, I wanted to learn how to monetize a website. And to a large extent, I did. I mean, it's just, you know, play money, but that's what I wanted to do. And I did. That's because I was bored with real estate. So I did something else, but I realized I don't want to do that either. You know, so it's really all, like, people come to BiggerPockets thinking that real estate is the answer. Real estate is the tool. It's just a tool. The answer is in your head. And if it's not there, I can't put it there. Brandon can't put it there. David can't put it there. I mean, it's you got to see the bigger picture.
So once you guys got to the point where you realized the bigger picture is multifamily syndication, tell me how you made the switch, what pieces you had to put in place, and then how you chose which market you wanted to invest in.
So Ben and I actually, when we first connected and we knew we wanted to partner up, we spent, probably 6 months daily, 12 hours a day, underwriting and coming up with our model.
Literally.
Yeah. Looking at markets. We looked at other markets. We went and put offers in other markets, got investment final.
You guys both lived in Phoenix at this point, right?
Yes. Yeah.
Okay.
We both live in Phoenix. But all this underwriting was on the phone. We were just on the phone. Our wives probably thought we were crazy, 12 hours a day, till 8 o'clock at night.
Sounds like 8 years ago, Josh Dorkin and I, it was the same thing every day.
Totally. Because the passion behind it.
Yeah, exactly.
It didn't have to do with apartments. It didn't have to do with real estate. It was a tool.
You were growing. But
we weren't passionate about the tool. We were passionate about the growth, getting from point A to point B to the next plateau. Otherwise, how do you get up at 4:30 in the morning? By 5 a.m., you're with a cup of coffee sitting at a table until 8 o'clock in the evening, take time to go pick the kids up from school and then hand them off to your wife, and you're doing more of that. It just doesn't work without passion. And real estate is not passion. It's not, like, I hate real estate. I'm very vocal, have been for a long time. I don't even like real estate. I just happen to be really good at real estate. It's my highest and best use. It'd be wrong of me not to do it. But I don't like it. Half the people I have to deal with, I wouldn't let near my house. What's there to like? I mean, but it's the growth.
But I think that's where our partnership came into play a whole lot. I mean, you're talking 6 months of we're all submitting offers, not getting deals. Yep. If you're on your own, you would think a lot of people would just be burnt out and give up at that point. When you have someone every day that you're on the phone with, tweaking the model, let's look at this a little bit differently. Let's go to a different market. So just having someone push you and hold you accountable, that got us through, I think, that first 6 months.
So maybe before we go into the market discussion about how you picked finding your market, let's talk about the partnership thing for a minute. David, I know you do partnerships. I do partnerships. You guys obviously have a partnership. For those listening, what makes a good partnership? What do you think made you guys work so well together? And how can other people find a potential partner? I mean, other than just emailing me and asking for an introduction.
I was just telling him the other day the amount of value he added to my life. Mm-hmm. That was that. I mean, I never considered partnering with anybody before, but the amount of value added to my life, that was it. It's yin and the yang.
Yeah, to that point, complementary skill sets. I mean, we're the opposite in a lot of respects. Even though we have the same views on real estate, our skill sets are completely separate. And I think that helps us a lot. And we balance each other out. Yeah. I'm the eternal optimist. He's the eternal pessimist.
Yeah. Didn't you give him a book? Like that. Yes. Tell us about the book you got after your first deal.
So after every deal, I get Ben a gift because we go out to dinner. And the very first deal, I got him Chicken Little. His Ben's sky is always falling.
But what's great about that, you're 100% right though. Like the eternal, like the pessimist and the optimist. I think that actually makes for a really good partnership.
Absolutely.
Because if you're too far one way, you start making stupid decisions. You gotta have somebody that's always like pulling you back, reining in a little bit. I'm curious, David, real quick, you and Mario, which one of you is the pessimist and which one's the optimist? Or do you feel like you both are one way?
He's the optimist. I'm the pessimist in that relationship.
I can see that.
Yeah, like I've talked to Brandon about this, and I didn't use the optimist pessimist thing. I used the driver and the filter. So Brandon is a driver. If you put something in front of him, he will find all the ways that he can make that work. He believes he can make anything work. That's part of why Brandon is successful. Like he just really doesn't think that there's anything he can't do. Not because he's arrogant, but because he will just throw. Like the guy's been going to jiu-jitsu with zero idea what he's doing. He's just getting throttled. And he just keeps going back. He's not even asking, what do I do? He's like, if I just keep going, I'll just learn it, right? Like he is the personification of the attitude we tell people you should have, okay? But Brandon needs people in his life like Sam's and Ben's that are what I call the filter. So he fills up a funnel with every single opportunity he can possibly find. And he says, I want to go do all of them. The filter picks which one is actually worth pursuing and says, you are allowed to go in that direction in this way. So he's just like the police dog that just wants to go and bite at anything that it can. He's just all the time. Go, 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 go. Well, it needs the handler that can control it and say, all right, you are allowed to go bite that person. Don't bite David, who's right next to us, even though his leg looks really good. You got to find that in a partnership. I'm a firm believer. I think it's Brian that probably plays that role for Open Door Capital. He's going to say, all right, Brandon, I know you love that deal. Here's why it's terrible. I'm not going to let you chase it. Let's go chase this one instead. But if all you have are filters, they never get anywhere. They sit in a circle talking about doom and gloom and why nothing will ever work and successfully avoiding ever making a mistake, but never making any money at all. You've got to have both sides.
I'm just such an optimist when it comes to Open Door Capital that like it takes an entire team of people to tell me no. Like Ryan's laughing off camera right now, nodding. It's like Ryan and Brian, like that. They have to gang up on me. I'm like, no, we're not building houses in Maui, Brendan. That's a terrible idea. I'm like, well, we can make so much money doing it. Yeah, it takes a lot of them. All right. So that's one huge part of the partnerships. How does somebody find that partner? What would you guys recommend if somebody's looking right now saying, I need that other person? Or maybe they're asking, do I need that person? Do you need a partner? I kind of cover both those things that we can talk about.
Well, first, I think absolutely you need a partner. I think everybody is going to go further with a partner. But how to find them, I think that's difficult. I think neither one of us were actually.
All right, good show, guys.
It's hard.
Neither one of us were actually looking for a partner. We just stumbled upon a partner. So I would just put yourself out there. I mean, start going to conferences, networking with people, going to meetups. Unless you're interacting with people, you're never going to find that person.
Conferences like BPCon 2020 in New Orleans
in October.
Anyway.
Yeah, exactly.
Probably sold out by this time, but anyway.
I think you need to know your own strengths first. Step one, because then you will understand what you are lacking and what you are ultimately looking for.
How do you do that? How do you know your own strengths?
You don't be stupid. you be pretty sharp about what you do. You have to know your strengths. If you don't know your strengths, get the hell out of here. What are you doing here?
Yeah, I think just asking the question, like, what are my strengths, is like the way you figure out your strengths. If you just don't even think about it, then you're just going to be.
If you have to ask yourself a question, what are my strengths? You're a dumbass. Some things
what I mean is by focusing.
But listen, let me give you an example. So we talked about it in liberal arts terms, right? David did and you didn't. Let's talk about the underwriting process, because with that, we're kind of like boiling things down to like real, actual shit that we do.
Okay.
I look at things I'm a violin player. So I see the imagery, I see the pictures. I've been doing real estate since 2006. I know how people act. I know what they do where their alternator breaks in their car. I know what that call sounds like.
Yep.
I know what the call sounds like when their kid sticks a toy in the flapper in the toilet and it leaks from downstairs. You know, I know what that sounds like. I know how that interaction impacts property. I know how, because I can look at the trailing financials, I know how it impacts the building. I know how that works. Okay. Sam didn't, because as smart as he wasn't wise. Because wise happens from experience, from being in the trenches. So
do you agree?
Perspective on stuff, right? So that's a good marriage, because I never reported to SEC and I never helped another company, set up a thing with the SEC. So I have no idea, classically speaking, accounting wise or anything else, what that's supposed to look like. Yeah. All I know is this is what's economic loss. This is why it happens. People are people. And I've experienced it for 15 years. And because of that, here's the number we're going to put in the underwriting, because it's going to represent that. So I start with that picture, and then I boil it down to numbers. He goes straight to numbers. So every time we underwrite a deal, we're doing it together. Like if it's remotely interesting to me, I send it to him and he starts underwriting, vice versa. We underwrite every deal together and we start from the opposite points of view. Like I'm more liberal arts, he's more just straight to the numbers. And what happens is we massage those two things together to arrive at what I think is our competitive advantage, because we're able to dial it in more so than either I could by myself or he could by himself. But he's very liberal art. I'm very liberal arts. He's very like stiff, just numbers.
So when he says we start from two different places, we actually have separate underwriting. So I have one underwriting and he has another. Now we come up with the exact same, if we use the same rent, same unit mix, same CapEx, we come up with the exact same returns, but they're built completely different.
And if we don't, we go to the underwriting and I say, Sam, fix my shit.
Yeah. So what you're saying here is like, Ben, you're taking more of a qualitative approach to the real estate side and saying you start from more of a quantitative and you guys meet in the middle and then you convince each other.
Exactly.
Yeah,
and
smart.
that back and forth is hugely helpful because I'm too much of a pessimist to capitalize on the opportunity. And he's too much the other way to recognize the risk.
Yeah.
But having those two perspectives married together works for us.
It's a really, really good point. I like that a lot.
I think it's similar to what Brandon and I do with ideas. So we'll each have an idea, and I'll typically look at it from the perspective of how much knowledge are we sharing with people if we do this? How does it fit into the rest of the world that we have? Can I make it efficient? Can it be synergistic? I'm looking at it from that. And then Brandon would just be like, yeah, but would anybody care? And I often never even think to ask the question of like, would anybody want this when I'm looking at it? Probably more like from Sam's perspective. And Brandon's looking at it from like, is there demand for this? Would anybody do any of the stuff that we told them? Would they even have fun or would they like it? Do people want this? And we're both looking at it like you guys said, the same thing, same ideas from different angles. And it's only when both of those, it passes both of our little internal underwriting systems that we say, yes, this is an idea we should implement for the podcast or whatever we're doing.
You know, Sam goes straight to the price per square foot, right? We're looking at an apartment and I'm asking myself, who's going to be interested in it and why? And so he goes straight to the price per square foot. Where's that land in the market? I walk into that apartment and I see an extra piece of countertop, which is almost like a desk in the corner. And I'm going, who wouldn't love this? I don't even care what price per square foot is. So now we have to marry that and figure out the price per square foot because there's an emotional value in why this apartment is going to be preferable to another apartment in the marketplace.
So this actually brings up a point for a lot of new investors, maybe people who aren't at this level at all of buying apartments, but think like I bought a house one time for $45,000. I approached it from the numbers standpoint, the Sam standpoint, we'll call it. And I said, $45,000, it'll rent for $800 a month. That is a hot deal. And all the numbers, I could run the analysis all day long. It worked out perfect. That property cost me on average $200 in lost rent every single month I owned it for 8 years. And then I sold it at basically a loss or maybe a break even of what I had into it. Why? Because I didn't look at the more qualitative of this is a freaking weird house and weird houses attract weird people, right? So like it was a weird house, a strange layout. It'd been remodeled by some guy who was just a tinker. And so he just did like weird things everywhere.
Are we talking about a Waldo here? What are we talking about? Or a pig?
It was basically a pig with some lipstick on it. Yeah. And I should have approached it from both sides, but I didn't. I got caught up in just one angle. Now, other people could have done the opposite. Been like, that house, look, did you see the kitchen? It was beautiful and blah, blah, blah. And then they don't actually run the numbers. They're like, oh, yeah, that deal sucks. So no matter what type of real estate you're going into, whether it's your first single family deal or you're trying to buy this 400-unit apartment.
You're selling a product. Somebody's going to want to buy that product in order for you to succeed. I don't care what the numbers are.
Yeah.
Who is going to be buying that product and why would they choose this product as opposed to the other? And with that, we can get into location. We can get into the scope of renovation and all of that is on the list if we want to talk about it. But it's a huge topic with it's like a bottomless pit. We can talk about that. And when you've got millions of investor capital, you have to think about all of it.
Yeah, and I think a good principle to pull out of this is pick a partner that sees your blind spots. That they look at the world from a different angle as you. You have the same goal, you have the same values, you have the same ethics, you want to get to the same place, you're going the same direction, but they're looking at things from the way you miss, and you often look at the things from the way that they miss.
Yeah, it makes a lot of sense.
And it's natural. Like, what makes a good partnership? Like, we don't have to do what David just said. Like, we don't have to sit down there and check it's just natural. That's the way it happens. And that's why the partnership works so well.
Yeah, that makes a lot of sense. I think, we've talked about this on numerous other shows, but this is why Ryan and I have worked so well together. I think it just kind of became a natural, like.
Well, he's also so good looking. I mean,
he's a good looking gentleman.
Looking at him all day long, no brainer.
Let's go back to picking a market. We talked a little bit about that, but you guys ultimately decided on Phoenix. Now, this show is not about investing in Phoenix, but I want to know, like, what drew you to Phoenix, and how do you decide on a market? How does somebody listening to this right now decide where to go and focus their invest in? Especially a lot of people listening are in LA and in New York and Seattle, and they're just like, I got to invest somewhere else.
Well, they're all coming to Phoenix.
They are coming.
But that's beside the point. I mean, that's why the cap rate's a 4.5.
Okay,
you know?
so how do you decide on a market?
But can I start us off?
Yeah.
Because it's the same continuation of the same. Here's the liberal arts, and here's the numbers. I moved to Phoenix 3 years ago. All I have to do is ask myself, why? I want the weather. I want the blue skies. I want the low property taxes. I want the low insurance cost for property insurance. I want to never see snow as long as I live. I want opportunity for my kids. If I like something, and that's really like a good entrepreneurial way of looking at things. Like, how do you get your ideas? Well, if I want something, other people probably want something. If I want to be here, other people probably want to be here for probably the same reason. If I want to, figure out how to do something better or faster or more efficient, other people probably do. So, that kind of perspective on life, like, if it's good for me, it's probably going to be good for other people. So that's my kind of very liberal arts of looking at what's a good market. Well, it's good for me for reasons X, Y, Z. Therefore, I imagine it would also be good for other people for the same reasons, because we all humans and we all basically want the same thing. But
this is where the whole idea, like, you start from the qualitative side, the liberal side.
That's right.
But if you just made a choice based on that, you might make a horrible decision. So that's why you have to back it up with data, which is where Sam comes in, right?
That's right. That's right.
Yeah. So then you come in.
So we actually have 6 factors that we use when considering when to decide on the market.
Okay.
First one, competitive advantage. For most people, this is proximity. But it could be, I'm getting deal flow in a certain area, or I know where a new path of progress is headed in this area. Can you think about some other competitive advantage?
I know somebody on the city board, and I know regulation is coming that's going to create opportunity. Probably not on a large scale like for multifamily, but like if you're going to run a better breakfast and you know that there's regulation coming that's going to limit that or help that, then, you buy an 8-bedroom house and you subdivide and put locks on every, that kind of thing. So being local is just an advantage.
It's huge, right? And I tell people a lot that if I was going to invest in another market, like I'm just going to build a small multifamily portfolio again, let's say in another market, I'd probably choose Minnesota. And they're like, well, why Minnesota? I'm like, because that's where my family lives. So my competitive advantage is to have like, 10 people I could call at any moment and be like, hey, can you go check this out? And I grew up there, so I kind of understand.
Yeah, except I know your family. Every 10 of them is going to be like, who's this?
Yeah. Oh, now he wants to talk to us. Mr. Maui.
That's classic, dude. Who are you?
Yeah.
You want me to do what?
All right. So, but that's the competitive advantage is that you either know something about the market, you have something in there, and being local is like the best competitive
advantage. I'll give you a real example. So we're in Phoenix. And I think IPA just came out with like their study of 2019 rents, and I think Phoenix grew rents by 8.3%.
That's one of our numbers.
Well, we'll talk about that later. But the whole point is, if you're looking at data, like if you're approaching this institutionally, and you're looking at some kind of market data, by the time it's collected, organized, and put before your eyes, that's, 6 months of come and gone, and you're about 4% off on trying to figure out where your rents are needing to be in order to underwrite this. So it makes it very inefficient, very difficult to be competitive in a good market. Yeah. So being local and knowing exactly, hey, here's my competition. I'm just going to look. I'm going to hold Sam's hand. We're going to pretend like we're a couple. We're going to go in there and look and see if they have a washer and dryer.
For those of you that can't see this video, Sam is a remarkably handsome man. I don't know what it is when I look at you, Sam.
Thanks,
There's something about something about your look.
He's my Ryan, okay?
Yeah.
And for those who can't, David, Green, and Sam look identical. You could be confused with the same person. All right, so you look. So number one is that competitive advantage. What else you look?
Number two, diversified economy.
Okay.
So if you go back to 2006, 1 in 6 jobs in Phoenix was construction related, but only 1 in 14 are now related to construction. So Phoenix is really diversified. We're now in tech, health and health services, education.
That's smart. Yeah.
So you want a diversified economy. You don't want something that's related on a Navy base or only. So that Navy base loses funding. I mean,
or perhaps an area that is dependent on the auto industry as the only source of employment for everybody that lives there.
Right. And it doesn't mean that you can't buy a fourplex and do very well in an area that's not diversified. But you're not taking $20 million of investor capital and buying $50 million of multifamily in a market that doesn't have good fundamentals.
I think that's a great point to make here as we go through these 6 things. This doesn't mean that you can't invest in those markets. There are plenty of ways to do it. I mean, I made my living in Grays Harbor, Washington, like the armpit of Washington State. Like that's where I built most of my portfolio wealth. And so it's doable everywhere, but I had the competitive advantage in that market because I knew and people, I love when people come into that market from Seattle and be like, I'm going to start buying some of these properties. I'm like, good luck. Like you're competing with me and I live here and I know everything about this market. And like, so a huge part. Okay. So competitive advantage, diversified economy.
So again, going back to we're doing large multifamily, we want to buy hundreds of millions of dollars of property. We want a population of at least 1 million people.
Okay. So population. Yeah.
So that's huge.
We look at that as well for the mobile home park stuff. Is you got to have.
Can I jump in real quick as far as something you guys mentioned that you said you want to be in the path of progress and you want to, that is an absolute, yes, you want to be in the path of progress. We typically look at that from, give me a formula for how I can find the path of progress. Our brains really like that, but the better way to look at it is to understand the principle of a path of progress, because Phoenix itself is in a path of progress. If you consider where I live in California with a massive exodus of everybody who is tired of how expensive everything is. So just you choosing a market that is where people that are sick of California want to go, you're already in a path of progress, right? Like think about like all the water that's like overflowing out of California and it's spilling. And if you look at the states that are around us, Idaho, Nevada, Arizona, Colorado, all of those markets have done Oregon, they're all doing really good because people are leaving California for what appears to be super cheap prices. Now, you guys understand where you live. That doesn't seem cheap, but to other people it does. And I just wanted to kind of highlight, I know that's part of what you guys considered when you chose Phoenix is you looked at, okay, all the people from the cold places want to go somewhere warm, and all the people from the crazy expensive places or maybe politically kind of weird places want to go somewhere that to them feels normal and is cheap, and they're all going to end up in Phoenix.
So you don't have our list, but that's actually number 4.
Sorry.
No, it was perfect intro. So number 4, population growth. So Phoenix is number 1 in the country in population growth.
Yeah,
it's number 1 because people from cold places want to come where it's warm. People from crazy high taxes places want to come where it's lower. People from California, which is just crazy, want to come to some place that's not California, and it's not great, so it's just an ultimate melting pot, a confluence of all of the things all of the reasons. Like Ben moved from Ohio to Phoenix. Well, he had his reasons. What other kind of reasons would people have to move to a place like Phoenix? Well, that right there.
All right. So population. Yeah. We were looking at a mobile home park collection, a bunch of them out in Illinois, like kind of in rural Illinois. And we decided, like, when we looked at everything was good. Everything was great. Like the numbers all felt great, except for population trends was like negative, like, 8% per year. And it was like, like people are fleeing this area. And we didn't want to get caught with something in an area where population is declining. So we decided not to. So population growth, huge.
That's right. So next, job growth. Our jobs coming. Phoenix is number 2 in the country in job growth. So you need jobs to be able to support that population, obviously.
Yeah.
If people are coming, they're not coming because there's no jobs. So obviously the companies are relocating the jobs, and that's part of the reason people are coming.
Yeah.
And then so those two lead in to the last one, which is rent growth, number 6. And that's the one that's really important, especially as multifamily. How much can I grow rents every year? if I'm holding this for 10 years.
Yeah.
And Phoenix is number 1 in rent growth, obviously, because if you're number 1 in population growth, number 2 in job growth, it's pushing up rents. And like last year, Phoenix has been about 9%. The year before that, 8%. So we're actually still having job growth, whereas a lot of the countries have been flat or negative in rent growth. And so, I mean, obviously you don't want to underwrite that projected to continue,
Sure.
But just to have that extra appreciation in your back pocket.
Yeah, that's great. All right, so let's review that list real quick. Just read them off, all 6 again, just so people can, if they're taking notes, they can get that, and we'll move on.
So number 1, competitive advantage. Why are you going to be better than someone else in that market? Number 2, diversified economy, not relying on one industry. Number 3, minimum population of 1 million. 4, population growth. 5, job growth. And 6, rent growth.
Oh, perfect. And what I want to point out, we mentioned this before, and I want to retouch on it, is it doesn't mean you can't invest in an area without 1 million people, right? This worked exactly for your guys' business plan, your strategy. So let's talk about that for a minute. Like, what is your plan? What is your strategy? And then I want to go into what have you done in the last few years since partnering? What kind of deals have you got?
So it's interesting because most people see multifamily real estate as a cash flow asset. You buy it, you get the rents, you pay the expenses, you get the money in the pocket, and that's that. We talked about flipping houses in the beginning of this webinar, and what I invite people to do is conceive, and I learned this from Brian Burke, conceive of multifamily as a long-term flip. Because if you are talking about flipping, what you are necessarily talking about is equity. And when you talk about equity, that's safety. Because if you have equity, you can refinance, you can sell, you can get out of a deal. You have options. So I think, part of that growth that happened, Ben going from small multifamily portfolio to syndication is, hey, if Ben is going to take $10 million of people's money, Ben wants to know how the hell he's going to get it back out and what the safety margins are going to be. And all of that comes down to equity. But Ben doesn't want to trust the market growing. It helps. You certainly want it to help you, but I don't want to trust the market to do it for me, which means I do extreme value adds. I improve this property, and this is where in a environment where rents are scaling up, if you're going to come in and do your renovation and hike the rents, that's the environment in which you can do it. If population is leaving, who is going to be willing to pay you even for a very nice apartment, right? So we look at multifamily as a flip. We may come out of it in 2 years. We may come out of it in 3 years, in 5 years, in 7 years, in 10 years. But ultimately, after repaired value is where it starts, minus the cost of getting there, minus the profit margin, minus the holding costs that are in multifamily built into the NOI, of course. And that's how much we can afford to pay. And basically, it's a flip. We think of it as a flip that's removed several years apart. So you're coming in today, and you're going to exit 5 years, 7 years, 10 years from now. But it's a flip. And you are thinking exit.
So you're buying value add stuff, which is like a fixer upper. You're trying to buy it.
Exactly.
So how bad are these properties you're looking at? I mean, you're talking like completely dilapidated, 100% empty, or are you talking?
No, so Phoenix has 4% vacancy,
okay,
and that's across the board. So we're buying places completely full, and in fact, I have to discount that because I can't underwrite 4% vacancy for the next 10 years.
Yeah.
So I'm actually hurting myself in my underwriting, and I have to actually do extra value add to make up for that in a market like Phoenix. Which is where our business plan comes in. So we're spending $12,000 per unit on the interior of each unit to completely renovate that unit. New flooring, new cabinets, granite countertops, stainless steel appliances, new lighting fixtures,
new
plumbing
boxes.
fixtures. Yep. So everything new in that apartment. But we're getting $400 rent bumps in some cases.
Wow, yeah.
So and when you're starting from 600 and going to 1,000. And that's a huge percentage increase.
That's huge. And because the value of a property is based upon how much profit it makes, essentially, when you can bump rents from 600 to 1,000, that dramatically increases the value of the property. So, and that long flip, like you said.
Well, and it actually does two things, two separate things, equally important things, maybe one more important than the other. Yes, right now we're getting the rent bump. But tomorrow, when there's a down cycle, there's always a flight to quality and down cycle.
Yeah.
I don't want to be holding resurfaced countertops and refaced drawers like everyone else. I want to have quality because that's hopefully going to give us staying power if we're caught in a down cycle in this property.
And reduces our expenses. R&M
CapEx, because everything is new, right?
Yeah.
All the faucets are new, the shower heads are new. So there's a couple of different angles on why we do what we do. But like as an entrepreneur, this is what I want. I want safety. This is what I have to do for safety. What market is going to allow me to do that? Well, I think Phoenix is going to allow me to do that. So I will do this in Phoenix. Can I do this in Ohio? No. On many different levels, no. The business plan is sound. It still makes sense. But the market won't let you.
Yeah, so the thing you do has to match with the market you choose has to match with the business plan, which is why if you live in San Diego, like maybe house hacking will work really well for you. House hacking kind of works everywhere, but
Right.
maybe like, burr investing isn't going to be a great option there, but house hacking is, or maybe multifamily is not a small multi isn't going to work there because you just can't get cash flow, or single family houses, right?
Yeah.
Most markets, like competitive markets, single family houses, it's hard to get any cash flow. So you have a choice. You can either change your business plan or you can change your market to accommodate your business plan.
Mm-hmm.
The two have to go together.
Yep.
Again, whether you're trying to buy your very first deal or the other, because too many times people are trying to fight for a business plan that just does not work in their market, or they're trying to fight for a market that just does, they have to go together.
Doesn't reward a particular business.
It doesn't,
plan.
yeah.
So like you can make apartment very nice and spend $12,000 interior and 10 more on the exterior.
Yep.
But if you're in Ohio and nobody makes any fucking money, who's going to let you raise your rent $400?
Yeah.
Okay. I mean, that's Ben being
Okay.
Ben,
Sure,
So-
but you make a good point there. And so, yeah, a good example of that, we interviewed a guy named Joe Asamoah on the podcast recently. He's in Washington, D.C., very expensive market. Hard to make single-family houses work there, but he's doing it. And if you guys want to learn how, go back and check out his episode. It was really good. I can't remember. It was like maybe in the 360s. Joe Asamoah. But he changed his strategy to work in that market. Now, his strategy might not work in Ohio or in Florida or in Phoenix, but it works really well in DC because of some things like how much Section 8 will rent for there. And he does like a certain level of rehab. And so speaking of rehab, I want to go back to that. Rehabbing these properties is a tremendous amount of work. Now I have, some mobile home parks and some apartment complexes, especially when I deal with a property manager. I'm like, hey, property manager, you just go and handle this rehab. Like it's always a disaster. How are you guys overcoming that?
Well, originally we were relying on our property managers. So they have 20,000 plus units under management.
Yeah.
We had them doing the renovations. But our renovations are really intensive. Not many value add investors in Phoenix are doing what we're doing with everything new inside. They're resurfacing the countertops,
Yep.
painting the cabinets.
So now you got to go find a bunch of contractors, and that's
Yeah.
hell as well.
And so we actually took that over 3 or 4 months ago, just because the process was a little bit too much for them, especially with how much we're buying last year. We haven't talked about it, but about almost 400 units last year.
Wow. So
500
you guys put on tool belts and started doing the work yourself.
Exactly.
Okay.
No. So we hired a crew. We started our own construction company, hired our own crew, coordinator, and now we run the whole thing from beginning to
Like
end.
employees. So you actually started a construction. That's
Yep.
awesome.
So we have 5 full-time employees renovating across our properties right now.
Wow.
Yep. But we're now turning them in like 1/3 of the time that they were prior. The quality is better, and our prices are better.
Yeah.
So worked out really well. That
That's
was
smart.
difficult, but
Yeah, it's not easy to go start a brand new business.
Well,
but-
and there's a critical mass.
Yeah.
You're not doing this for 100 units. You
Yep.
can't afford to. There's not enough money. Same as, we always talk about PM, right? How much PM do you underwrite? Well, let's just take 10%. But if your building is too small and your income on the building is too small, you could end up paying a lot more than 10%. It's all about dollars. So there's a critical mass. There's a number of units. There's a number of magnitude of number of apartments. It's you can't hire one guy because then there's no redundancy. Like if you have 100 units and you hire one guy, like you start a construction company, hire one guy. You can't hire a coordinator, which means now you've bought yourself a job of coordinating this one guy that you hired. And B, if he happens to be sick, nothing gets done.
yeah.
So you can't have one guy. You got to have 2 guys, but you can't have 2 guys for 30 units because you can't afford them. So now you have more units, right? So it's all like we grew into it very naturally. And then it was like no brainer.
Yep.
Yeah, that makes a lot of sense. Yeah, taking it in-house is interesting. I've done both, on the smaller scale, where I hired at once a gentleman just to run the rehab, because I had like 5 rehabs going at once. I hired one guy, brought him in-house, employee everything, and it was fine. But then like the jobs ran out, and then I didn't have a use for them anymore. So like that kind of fell apart. And so that's the danger of going, in-house. And maybe it's not a big deal. I've hired temp workers. That was a disaster. But
so that's another thing. We hired really good workers. We got people who had specialties in what they were doing, but they can do everything else as well. But we also paid more than what the market. The prior team, they were paying $13 an hour. You had high turnover, people just not showing up. Well, we're paying $20 an hour plus health insurance.
Yeah.
And we're guaranteeing them 40 hours a week. Even if there's some downtime, because it fluctuates. So say you get 10 units on the first of the month, and then you would install cabinets, and then the countertop vendor needs to come in. They're in there for a little bit. And so what are their guys doing? Your guys might have some downtime, but we guarantee you're going to work 40 hours a week. So you get quality people when you can do that.
Yeah. And health insurance.
Yeah. That's helpful, because then you get way better people. And even though you're paying them more dollar per hour, you're paying actually less money, because before there were so many people in the overhead of those contractors taking a piece.
Well, and not only that, I mean, they were taking sometimes 90 days to renovate a unit. That's a lot of vacancy. So sure, I'll pay someone more, but if I can estimate that I know I'm going to be done in 30 days, then that cuts me out a couple $1,000s of vacancy.
Yeah, that's smart. Very smart. All right. So let's go to where you're at today. I mean, so what have you guys done now since being partners? What have you guys bought, and what have you done?
So in the last, what has it been, 18 months now since we bought? Almost 18 months. 17 months. We bought 500 units.
Wow.
50 million of acquisitions. We raised about 20 million.
Wow.
Yeah, and that's spread across
just
4
a walk in the park.
Yeah, easy stuff.
Walk in the park, Kazansky.
Yeah, and how do you find these deals?
They just fall in our lap.
I was gonna say, driving for dollars for these things.
Yeah, driving for dollars. Yeah,
it's a mix. It's a mix. So sometimes you're going on market. You're going through like what's called a best and final for multifamily, getting through a bidding process. Some of them completely unsolicited offers go off market. But now, actually, I pushed Ben at the very beginning, and he hated me for this. But I pushed him to close in like 30 to 40 days, where contractually I had 60 days.
Yeah.
But I just wanted to be able to close really early and have that. Because when you go through a best and final, you get it's called a questionnaire.
Yeah.
And they ask you your last few closings or transaction history. So when I can say that I've closed 30 to 40 days on average, even though the contract gives me 60, they love hearing that. So actually, we had our last property. It was already being sold. It was under contract, and it fell out of contract. And we got a call because they knew we could close quickly. Hey, can you guys come in and get this? And so you don't get opportunities like that if you don't close early. So it's a bit of a mix. Actually, all 4 properties I think were a different acquisition like that. But actually, funny enough, they're all from the same broker so far.
Oh, funny. So one guy is like your
one firm.
One firm.
Yeah, he's being your rockstar. Okay, so that's cool. So you are getting these. I mean, these are not. You're not like direct mail marketing or anything like that at this level. Like at the large apartments, you're not doing.
No.
Well, especially in a place like Phoenix, you can't find an owner who's unaware that he's sitting on a pile of gold.
Yeah.
Period.
Yeah.
Like everything's trading at under 5 cap, and condition doesn't matter. You can't. You can't. And to think that we can compete with brokers whose job it is to communicate with each and every owner in town and who know everybody.
In most big markets like Phoenix, there's 4 big, very large brokerages, and they handle all of the volume. I mean, nothing really gets traded at this level outside of those brokerages.
And they're very protective.
Yeah. And they spend decades building relationships with all of these owners.
Yeah.
So you're really not going to go around them through direct mail marketing.
Yeah. Okay. So yeah, because like again, this goes to the strategy. Some things work better in different markets for different types of properties for different levels, and so you guys are just you're doing what's working there. You're working with the brokers, and I really, really love that tip. I just want to emphasize that because I don't want to gloss over it. That idea of like closing quick so you can tell people in the future what you've done.
Mm-hmm.
Something we do in Open Door Capital is we're always trying to like. Do you find like what's that one thing when you're competing, like what's that competitive advantage you have? So we fly in no matter what. Like we'll jump on a plane and go anywhere, anytime, immediately. Like, even if it's just like this one might be coming on the market soon. Like we want to be like to show them that we are willing to jump on a plane and go look at the property. I'm like,
what's he talking about? Open door? Didn't he mean to say Whitehaven? Is he confused?
Do you guys do the same thing? You guys don't have to
So actually, I mean, we don't have to fly. But actually, when we go to a property, we show up with our entire team. We're not even under contract yet or submitting an LOI, but we show up with our property manager, the VPs of construction.
Again, goes to that location that we talked about. One of the kind of competitive advantage. Number one, being local.
Yep. Right.
Our HVAC, our electrical, our everything. We've got people on the roof.
Yeah.
You know, with permission, of course.
But we're inspecting the entire property when we're just doing an average tour, and they're not used to that.
But that's also that brings up an interesting point, because you know, everybody wants to go through every apartment. If I'm going to rip everything out of every apartment, do I really care what the kitchen looks like? No. All I need to know is foundation solid? Yeah. Am I having to replace the roof within a year or within 7 years? Is the electrical good? How are we doing in HVAC? That's it. Because I'm going in there with a business plan that says $10,000 to $12,000 a unit on the interior. Plus, we're going to redo the paint the building, build this, build that, and you know, it's easy to work with us. But it works for us because that's part of the business plan.
Yeah.
We're not being inconvenienced by having to make these grandiose plans. That's part of the chosen business plan.
And another way we stand out is we never retrade, which you don't want to have the reputation, especially in a small market. What
do you mean by retrade? Explain that.
So you get it under contract.
Yeah, you're not talking to professional real estate.
So you get under contract, you have your inspection period. I go in and I say, oh, I didn't know that the roof was in such bad condition. I'm going to need $100,000 discount to replace the roof. Yeah. And that's called retrading. And when we get that questionnaire that we talked about earlier, Invest in Final, they ask you, have you retraded ever? Yeah. And they want to know all the details, and they're going to talk to your broker and the lender on what the circumstances were on that retrade. So we never retrade. We go in almost always, I'm going to replace the entire roof. Last summer, we bought a 164 unit. They put on a brand new roof while we're in escrow. We still had it in our budget. I'm going to replace the roof. We just automatically, I'm just going to assume that I have to replace it so that I never have to retrade later on.
And then the reserves for capital expense and for other things, they're cells in the underwriting that never change. They just are. They're there, and we don't touch them.
What does somebody look for, like in multifamily? What do you guys typically look at for CapEx in terms of, like, you know, if you had 100 units?
We're kind of nuts about capital. Like, we want to be really well capitalized, right? So we go overboard. So of course we're going to have the roof.
Yep.
We're obviously going to have the paint. We're going to have whatever project specific we're going to do. Are we remodeling this office, or are we building a new office? And we do both. Okay. Or same for the gym. Are we doing that? Aside for that, are we taking 35% of the HVAC just to replace 35% of the HVAC to have the money in the bank? It's supposed to come out of the cash flow, but we want to have the first 35% of the units replacements. Same for the water heater. Same for plumbing contingency. Same for electrical contingency. Say, you know, like, then you have these unnamed items. You know, okay, this is 100 units. We're going to take X number of dollars per unit. Then on top of it, we want X number of dollars.
We basically have like what we call working capital, 9 months of debt service the building. So if something happened catastrophic, I could pay for 9 months of the property, and before we'd run out of working capital. I guess so. On a $4 to $5 million equity raise, about $1 million to $1.5 million of that is what we call our margin of safety. So it's made between working capital, contingencies on the construction, reserves,
floats.
Construction floats. So the lender pays for our construction, so we actually have to pay for it up front and then get reimbursed. And so you need a pretty large construction float to manage that. So about $1 million of that is just going to these extra reserves and our margin of safety.
That makes a lot of sense. And by the way, if people aren't unfamiliar with what I'm talking about when I say, like, we're talking about CapEx, what we mean is
capital expenditures. So anything that I'm spending to improve the property beyond just your...
And anything that's frankly going to... There's a depreciatable item, so it's going to last more than 30 seconds. You're replacing a pipe that goes from the street to the building. you're going to put it in the ground and it's going to last for 25 years. That's CapEx.
Okay, yeah.
That kind of thing.
So tenant punches a hole in the wall, that's a repair.
That's a repair.
Okay, and that's why on the BiggerPockets calculators, which I wouldn't recommend doing for a 200-unit apartment complex, but if you're if you're buying because there's a level of sophistication when you get into the large multifamily that you really got to underwrite a lot of stuff. But that's why even on a simple calculation, like you're trying to buy a duplex, like CapEx is a real number. This is something actually I learned a lot from Ben here years ago, is you went through this blog post where you said, look, like CapEx is a real thing. You took the price of a roof, the price of windows, the price of everything, and you said, look, here's all the stuff, and this is the life that it lasts, and here's how much it costs. So if you run all those numbers on the basic 20 items in your property, it's like a couple $100 a month on a house that you're just losing in potential CapEx.
That you should be setting aside so you have the money to deploy. Yeah. And that goes back to depreciation that we get, right, on our taxes. Well, everybody thinks that's just a gift. It's not a gift. It's the IRS saying to us, don't be stupid. We know you'll have to spend some money later, so we'll make it less painful for you, and we'll give you some savings today. Don't be stupid. Set it aside. So tomorrow or day after tomorrow, or 5 days after tomorrow, you have the money to spend on this stuff.
Yeah.
It's not an if you're going to spend it. It's a when you're going to spend it.
Well, and the lender, they want to protect themselves, so they actually calculate the same thing for you.
Yep.
And they give you that number, whatever it's usually around $250 per unit per year.
Yep.
And they just want to hold that aside in case.
And by the way, I would not do $250 per unit per year for a duplex. Your CapEx can be way higher for a smaller unit because you have the efficiency.
And I would only do $250 per unit per year if I have 35% of the HVACs replaced in my CapEx,
and everything interior is getting replaced,
and the interior is all brand new, and all that stuff, because it's really more than
CapEx can completely kill it. Here's an example I give people a lot. Let's say you bought a single family house and you're making $100 a month in cash flow. Good for you. You really feel good about that. And the whole first year you made $1,200 in cash flow and you feel great. 10 years later now, you've made $12,000 in cash flow. And then you had to put a new roof on, and the new roof cost $15,000. Where you thought you were making money for 10 years, you actually lost $3,000 over that time period. And then then 5 years later, you put a new fridge in, and that's another $2,000.
And we're not even talking about tenants trashing the place.
Yeah, we're just talking about the fact that things wear out. If you don't account for those things, you will have to pay that piper eventually. And so that's why I always put in typically on a single family, I'm $100 to $200 a month, a lot based on what numbers you came and just what I've seen in my own life. And then on the larger multifamily like that, the $250.
Well, again, it depends. If you have a boiler, you're gonna set aside more if you're not stupid.
Yeah, and if you have a lot of HVAC stuff because you're in Phoenix or if you're in Minnesota, you're gonna have a lot more expensive than if you're in
and
South
if you're in Minnesota, you got to replace the windows.
Yes, things like that.
Because it gets uncomfortably cold.
Yeah, so CapEx changes per area.
Absolutely, it does.
So here's one of the hardest questions on real estate, and there's not really a good answer for it. How do you know CapEx? If you're just getting started, you're trying to buy that fourplex, what do you even assume for CapEx?
I've got an answer for you.
You don't buy fourplex. Ohio.
No, you don't assume. You think of it as a flip.
Okay.
I'll give you this example. If you buy a fourplex for $140,000 and you go through ownership of that fourplex, and in 4 years you say the fourplex is worth $200,000, even if you have to spend money on CapEx, you feel okay about it. Because why? Because you can get it back. Because the thing is worth $200,000 now. So you have an exit. You can refinance and recapitalize yourself. You can sell and recapitalize yourself. However, if you bought a fourplex for $140,000, you're still going to have CapEx, but it's only worth $140,000 still 5 years from now. Guess what you've done with the CapEx? You've thrown good money after bad. This is why I advise people, and I've learned this myself, it's all about the equity. Cash flow allows you to stay in the game long enough to execute the business plan, which is about the equity.
Can you explain that a little bit more? I think that's a really good point. But a lot of people think they're just going to get rich off cash flow, and cash flow is not.
Well, and you can in a specific window of opportunity during a cycle. Mm-hmm. If you are buying, rents of $900 today, but you managed to buy them in 2011 for $30,000 a door, you're going to be making a lot of cash flow, and that applies. However, 2009, 2010, 2011 was an anomaly. There was a very wide discrepancy between what the price of that unit was versus what the rent on that unit is and will be. That was an anomaly. It's never going to happen again. So going forward, you just have to be careful to understand that Warren Buffett says diversification is protection against ignorance. I say growth and equity is protection against ignorance in income producing assets, because income comes in, income goes out. But if you have an exit and you can make money by exiting, then at least you are not losing money. Income is a fickle thing.
Yeah. So to put that in my own language, like if I buy a property, I want it to cash flow, because if it doesn't cash flow, I lose money every month. Now I might just the property because I can't afford to keep it. But if I can make some good cash flow every single month, ideally, then even when I get hit with the CapEx and stuff, even if I held it for 10 years, what if I didn't make I didn't make a ton of money in cash flow, but I own a property for 10 years that's hopefully worth way more than what I paid for it. The loan's gotten paid down a bunch. I've gotten a bunch of tax benefits. And that's where that equity, the difference between what now it's worth, which is now worth, let's say 500 grand, and now I only owe 200 grand, that 300 grand now, that's a chunk of money. I sell the property and I can dump it. Now, some people just want to buy properties, a few of them, pay them all off to zero and just live on that cash flow. That's fine too, because then you still have equity because you just paid out the property. So, but the point is the wealth is built from equity. The cash flow just helps us maintain.
That's
hopefully
exactly it.
Helps us pay some bills in the meantime.
And you discover that when it happens to you.
Mm-hmm.
And it happened to us. It's like, it's nice that this thing's cash flowing $500 a month, but this $80,000 in my pocket from selling it is
that's real
a
money,
whole lot nicer.
Yeah.
Not to mention that now I can reinvest it and, double, triple, quadruple it.
Yeah.
Right. So, and that actually happens. And then you go like, cash flow?
Yeah.
Like, it's almost heresy, right? To talk bad about cash flow, where you and I came from. Sure. I mean, like back in the day, you and I.
Well, it's because we came out of the recession where everyone, like in 06, 07, they didn't care anything. They're like, yeah, lose $500 a month. Who cares? I'm going to double next year. Like, because everyone was only focused on appreciation. And
right. And then everybody lost their job.
Yep.
And then we were like, oh, dude, I don't want to work for the man because I don't want it to happen to me. I need the cash flow because that cash flow means I don't have to punch the clock.
Yeah.
So we swung completely the other way. And the truth is always somewhere in the middle. You need both. You need cash flow or you can't stay in the game. You need equity or you can't get rich. And that's just all there is to it.
Anyway, add that before we move on.
We underwrite, so a lot of flexibility. So cash flow gives you that flexibility to exit whenever you want. That's what I think Ben's main point was. So if I want to sell in 3 years, if I want to hold it for 10 years, cash flow is the thing that allows me to hold on to it for that long and not be forced to sell. So we underwrite like 3, 5, 10-year exits. We structure our debt that allows us to exit when we want. So you have to know that from the beginning when you're doing a deal and underwriting. What is that going to look like? And what are my different points and options? And what's going to allow me to get to each one of those points?
Yeah. And flexibility to choose. Like we have 2 deals going on right now, and one of them we're going to exit. Another one is basically a fancy burr because we're going to refinance it because of what it is, where it is, and how it's doing. We're going to do better for ourselves because we can pull basically all our money out, all our investor capital out, and still sit in the deal and cash flow it. And
yeah, burr investing in apartments is a phenomenal strategy as well because you can get your investors their money back that you raised. For those who are not sure what I'm talking about, burr is you buy a property, you rehab that property, you rent that property out. Now, usually we do it on small deals, but it works on big stuff. Yep. And then once it's all fixed up and nice, whatever, instead of selling it like a flip, you just go and refinance it. Go to a bank, get a whole new loan, pay back all the money you put into it. Now you have a lot less money, maybe no money, but maybe just less money that's actually left in the deal. Right. When you have no money into a deal and you're still making cash flow, that means your return is just through the roof.
Right.
And, ideally. And so that's where you can get stupid good, even infinite returns by doing that.
Right. And you're de-risking.
Yes.
There's no risk.
Yeah.
You're risking the equity that you built, but you're not risking your money. You're playing with the bank money.
Yes, because you already pulled your cash. You got your money back out. Yeah. All right. So let's move on to the next segment of the show where we learn more about specifics about one of your guys' deals. So this is time for the deal deep dive. where we're going to dive into one deal. So you got something in mind that we can tear apart?
Sure. Actually, do we have enough time for 2 deals? Because Ben mentioned that we're doing a flip and then a burr basically on two recent deals. So I think it would be nice to talk about both.
We've never done a double deal deep dive, but today we're doing the double deal deep dive.
Well, there's two of us.
Two of you.
So it's only fair.
All right, let's do it. So we'll go through 1 through 8 questions on the first one and then go 1 through 8 on the next one. All right, number 1. Let's go to the first one. What kind of property is this?
Well, if you've listened to the last hour, you probably know that it's 100-unit multifamily. Okay. This one's actually 98 units. So, multifamily. So right, yeah.
Wait a
yeah. Do you remember Josh Dworkin's response?
Yeah, what was it? Yeah,
when he found out it's not over 100 units, Benjamin.
Yeah. How did you find this? How did you find this property?
This one was actually our first property. Okay. Got it from the broker. It was on market. They were actually going to go to call for offers and then best and final. While we're on our tour, we asked the broker, will he be willing to sell and skip all of that if we give him the price he wants? And we had that number and we got an offer. So we got to bypass the best and final. So that way I'm not competing against big companies I'm not going to look great against when it's our first property.
Number 3, how much was the property?
We bought it for $8.2 million.
$8.2 million. Ouch. How did you negotiate this property?
Well, like
you kind of told us, yeah.
Phoenix is a really hot market, seller's market. They kind of just say, this is my price. Yeah. And actually, we were able to underwrite even higher than that. So we went with what they asked for.
Yeah. I feel like you got actually a good enough deal. All right, next one. How did you fund this property?
I don't know if we've talked about this, but we're actually syndicators.
Oh, okay, good.
we
you raise money
together and then we get a loan for the rest.
And all right, you guys usually do 506.
506B. Yep. So we have a sophisticated and accredited. But we get, and then for the financing, we do a bridge loan, 3+1+1.
What does that mean?
So 3-year initial bridge loan, but we have 2 1-year extension options.
Okay.
Well, we need to talk about that because we need to talk about that, right? That's actually one of our safety triggers. Now, why is it safe, Ben? You have to refinance in 3 years because it's only a 3+1. They're like, what's safe about that? Well, and then everybody else, you go on Facebook and there's nothing but syndicators there in 2020. And everybody gets these 10-year fixed interest rate deals. What people don't understand oftentimes is that ability to exit is probably the greatest safety trigger that you can have with any real estate. You just need to be able to exit your position. That ability is very limited by your prepayment penalty. And the privilege of a low fixed interest rate for a very long period of time is you pay for that privilege. But both Freddie Mac and Fannie Mae, in exchange for the benefit of that fixed interest rate, you potentially could look at millions of dollars of prepayment penalty, which of course very significantly hampers your exit.
Yeah.
Because it could completely destroy your returns on that exit.
So that's tied to fixed rate. But what you could do is variable rate. And they're a little bit higher interest rates, but I don't have that huge prepayment penalty. I just 1% usually, or they have sometimes a step down.
Yeah, but when I think variable, I think of 2007 where my rate went from 2% to 29% overnight, and now I'm bankrupt.
Right, and so that's why most people don't do it. So what we do is we buy an interest rate cap. And so we actually cap it at...
Which is an insurance product.
Yep.
Interesting.
So we hedge the interest rate. So basically say if the rate goes above today's rate, a third-party insurance company pays that increase, not us.
Oh, fascinating. I didn't even know that
existed. So we just factor that into our closing costs every time, and we just calculate what that interest rate cap is going to be to calculate that.
I mean, that's a whole another conversation, because if you look at the market today and you see what the Fed is doing, what are the chances the interest rates are going up anytime soon? But with that aside, once you contractually cap your rate, you have 3 years now to figure out how to refinance or how to exit if you want to +1+1. So you got 5 years really to figure out what to do. So if the rest of your business plan and your underwriting is intact, then there's a lot more risk with having to pay defeasance than risk of not being able to roll the debt.
Defeasance meaning like prepayment. That's
It's just one type of prepayment.
Yeah. I'm curious, just on the last thing on the funding thing. Do you remember how many people like to raise money for that deal, $8 million?
I think it was about 60 investors on the first.
About 60 investors. And how much did you raise then versus how much was the loan? Do you remember?
The loan includes 75% of the purchase and 100% of the capex. It was about 7.3 million.
Okay.
We raised 3.571 million.
Okay. I think I'm in that one.
Yes, you are.
Wow. What did you do?
With all your money, you gotta find a place to stick it.
You gotta find a place to put your money. And
Brandon Turner.
What did you do with that property?
He wants a raise.
We're finishing up our flip right now.
Ryan is. It's hilarious.
You guys probably can't see on camera, but there's people off.
Oh yeah,
we have an audience.
We have a studio audience, live studio audience today. All right. So what did you do? What did you do with it?
So like we talked about, we completely renovate it.
Okay.
We do a lot of common area amenities too. So we add a fitness center, we redo the clubhouse, the office. So actually we just finished all of that. We're about halfway done with the unit renovations. And we're actually pretty going to sell for almost our full exit price, only halfway renovated.
Wow.
So we're actually on the market right now. We don't have a sales price, probably going to go between 13 and 14 million.
Wow.
So
That's great.
So that'll be a nice flip. It's about 30% IRR where we underwrote 14 and 15%.
Yeah, that's crazy. Congratulations, guys. That's very cool. All right. So
sounds to me like you'll be making some money.
Sounds like I might be making some money. What lessons did you learn from this deal?
We've gotten even more conservative with our underwriting. We've got more liquidity, and we've discounted our cash flows even more.
That's cool.
With every deal we did.
Very cool. And on the syndication, it was a 70-30. Is that how syndications work usually?
Yes.
Yep. Ours is the 8% pref, 70-30 split.
Yeah. Very cool. So at the end of the day, and we don't have to necessarily talk about this, but like what I mean by 70-30 is that the investors, so like people like myself and others who invest in the money, they get 70% of generally the deal, and you guys as the sponsors get 30%, even though you're not putting up all the money for this thing. I mean, like the investors are putting the money in, you're managing the deal. So at the end of the day, you'll get a big paycheck at the end of the day. For making this thing work.
And that's after you got the first 8%.
Correct, yeah.
Yeah.
Okay, yeah. So I get the 8%, and then we split things 70-30.
Everything after that.
Yeah, this is what's so cool about syndications is that it basically, I mean, you guys have, obviously you make some fees in the meantime. You get property management fees and asset management fees and stuff. But like, at the end of the day, like you do a good job. I'm happy because I make a good return on my money. Limited partners are happy, but then you guys make a good chunk of money at the end. Again, equity. Now you can dump that into future deals of your own, and like, syndication is a cool business model, but it's not an easy process. I mean, you guys have been working this for years, learning how to perfect these models and stuff. So very cool. All right, let's move on to the next deal deep dive because we wanted to do two. What was another property? What was this one?
So this one was just a few months later, 117 units.
Okay.
Different part of town, still in Phoenix. So this one was actually completely off market. We submitted an offer. We had our broker help us look for properties. Someone he had a relationship with submitted an offer, and they countered, but it was still well below what we had. And I think we paid. Well, I guess we can talk about price, but it was like 91 a door or something, which was really awesome.
93,
right. Yeah, that was the next question, Dennis. How much was it?
It was 10.8 million, 10.75 million.
Okay. And any negotiation tactics in there? Anything you learned from?
We submitted a really lowball offer, and they came up a little bit, but not too much, but it was well underneath what we underwrote we could pay for the property.
This was a very big seller. This was an institutional seller. So I don't want to hear comments about, hey, you found mom and pop and you took advantage of them and lot. These guys have been around for years. They're huge, like really, really one of the biggest owners in Phoenix, which is a 5 million population place. It's not really a small place. Yeah. To say that you're one of the biggest owners there is something. Yeah. So this was very legit, arm's length transaction, but they had a circumstance which had nothing to do with performance of this property. They just had a reason to get out, and they had a reason to do it quickly and quietly. And we just happened to come along, and we were a known commodity somewhat by then. And so they did it.
And I'm convinced, so they had billions in assets, or they have billions in assets. And I'm convinced that they didn't realize what was happening around this property. A lot of new construction development going around this property, where a few months after we closed, so we bought it low 90s a door. A few months after we closed, stuff's in like high 130s per door.
Wow.
And very similar properties. So I just think that they had bought in the bottom of the market. They had so much appreciation. It didn't make sense to keep tabs on it. They weren't really raising rents too much. They just didn't know what they had.
Well, they didn't need to. That was a different cycle, different business plan. But this property, because of where it is, it's like, 2 months after we bought, there were things selling for 135. A month and a half ago, something sold for almost 200,000 a door.
Wow.
So that's what makes this a burr, because all in, renovation, escrows, deposits, CapEx, everything, we're into this 115 a door. So knowing that things is already trading at almost double, it's like, why don't we refinance and hold on? Because with what's going on in this location, nothing but good things can happen. So that's what makes it a nice.
So that was my next two questions. What'd you do with it, and what was the outcome? So you did refinance, or you're going to refinance?
We're going to refinance.
So we're about halfway done renovating all of the units. We just finished, as of I think tomorrow, our new signage goes in. We're rebranding the property, or maybe today. And so we're done with all of that, and later this year in about 6 months.
Yeah, because we have people. We can be out here talking to you
out here in Maui,
and we have signage going in. See, we're big.
You're not strapping tool belts anymore.
Very good looking and very big.
And so later this year, we'll hit the numbers that we need to be able to pull out all, or most of, if not all, of the equity.
That's cool. And so just to confirm, so when you pull out, like let's say you're doing a burr on a large multifamily, when you pull out the equity, and then let's say you pay back all your limited partners, like they get their money back. They remain,
they're standing in the deal.
Okay, they're still in the deal. So it's not you're paying them and they're like, all right, you guys are off now.
Nope.
Yeah, they're still owners. So now they're owners of a deal, getting cash flow from a deal with no money.
They have no money in the deal.
And which is awesome from an investor.
Which is ridiculous.
Yeah, we've been talking about the exact same thing with Open Door Capital.
And if we don't sell it, then there's no capital gains and nothing to worry about.
Very, very cool. Yeah, you're right. That's awesome. All right, so what lessons, last question, what lessons did you learn from this deal?
Submit a lot of unsolicited offers, I guess.
Yeah.
It's our best deal.
Actually, listen to your broker.
Yeah.
He brought this deal to us a couple of months prior. And we kind of looked at this location, and I think we kind of felt about it the same as the seller felt about it. Just like, nothing there, and we didn't really take a closer look. Well, the broker went and looked at the property. I get this call from him, and I'm on my way in the car coming back from another property Sam and I looked at. And he says, you guys are nuts. You need to come down here and take a look at this. There's like 24-hour fitness across the street. There's like all these offices that built. He says, I didn't remember any of this being here. There's gated community with selling for $400,000 to $600,000. And this all came up in the last 3, 4, 5 years. Yeah. And this, so I went and I was like, Sam, we should make an offer.
That's how it happened. All right. That's good. That was a good double deal deep dive today. Yes. Now we're going to skip the fire round today because this has been a long show and move right into the world famous four. All right, time for the famous four. This is the part of the show where we ask the same 4 questions that we ask every guest every week. I know we've asked Ben before, and you have not had a chance, Sam, to answer this one, so we'll go for both of you, though. All right, with that, let's get to the famous 4. Question number 1, each of you. What is a current or a previous or somehow in your life most important, favorite, however you want to call it, real estate-related book, other than your own? I don't know, Ben, you wrote some.
One of the first ones I read when learning about multifamily was I'm sure everybody said it, but The Complete Guide to Buying and Selling Apartment Buildings by Steve
Burgess. Yeah, great book.
How I turned 1,000 into what, 1 million or 5 million?
It was like 1 and then 3, then 5. Yeah. He just kept getting richer. So
I don't think it's in print anymore.
Yeah.
But it is the formula. Like at the time, I was like, well, dude, I don't want to flip houses. He was actually discussing burr.
Yeah.
Basically. Because he was renting most of them. But it's like what we do with apartments.
Yeah.
I didn't have the intellectual worth to compartmentalize it that way. But that book tells you everything you need to know about real estate.
All right. Number 2, business book.
One I'm reading right now is the Checklist Manifesto.
Great book. Yeah. I can see you liking that book.
Yeah. Well, actually, coming from the CPA world, they live on checklists. There's checklists everywhere.
Yeah.
So just getting back into that habit with real estate.
There you go.
So the last one I listened to, I can't remember the name of it, but the dude hired a Navy SEAL.
Oh, Jesse Itzler.
Yeah, Jesse Itzler.
Living with a SEAL. Yeah, that's a
I loved it.
book. Yeah, it was a great book.
Just like every morning I get in the shower and wash myself. Of course, I wouldn't do any push-ups or anything because that's too much work. But, you know, I do get in the shower and I turn the thing on. And his wife is so successful.
Yeah.
That's the most spandex. What's her name?
Just Spanx. Yeah. Jesse Itzler and
Shark Tank.
Yeah. What's her name?
She's fantastic.
Yeah, I don't remember her name anyway.
Like
Sarah Blakely.
Yes. Yeah. Especially the chapters you talked about her, because talk about nothing to blow up.
Yeah, she is Jesse was a podcast guest of ours on the BiggerPockets podcast, episode 313. If you guys want to listen to the author of that book, Jesse, he tells us a story about living with a SEAL. It was a great book. Yeah, phenomenal book. Number 3, hobbies. What do you guys do for fun?
We travel to Maui and visit Brandon.
That's true. That's exactly what we do for fun. And we hang out in the pool. And you guys, have you been to the beach yet?
No.
Should we go right after this? Should we just end this interview right now and go to the beach?
Go to the beach. Yeah, you got to get to the beach in Maui. Maybe Ryan will take you to go see some hammerhead sharks or something.
I like traveling. Canyoneering is one thing. I don't know if you've heard of that.
Canyoneering?
Yeah. So you actually start at the top of a canyon and you traverse your way down, whether it's rappelling, climbing.
I always wanted to do that. I didn't know what it was called, but
yeah, it's pretty awesome. Actually, really popular in southern Utah and Zion National Park.
But you've not done it at the Grand Canyon, have you?
No, not at the Grand Canyon. I've done it in Arizona and southern Utah.
Didn't your wife tell me she's never been to the Grand Canyon and you live in Phoenix?
That's correct.
Yeah, you got a vacation to take.
Yeah. So
have you been to the Grand Canyon?
I'm old and rich. So I pay people to do canyoneering for me and to play with shark. I pay them for that.
Yeah, so you don't
and tell me all about it.
Yeah, there you go.
Maybe make some movies, take some pictures.
There you go.
You know, I'm spending a fortune on my children.
Yeah.
And
they're talented kids.
My girl is always gone doing auditions and this and that with her mom. So I'm home with my son. That was them calling and saying, honey, you've been gone for too long.
All right. So final question from me today then. What separates successful real estate investors from those who give up, fail, or never get started? Let's start with Ben.
First of all, I don't think real estate investing is right for everyone.
Okay.
Can we just acknowledge that?
All right. Sam, what do you think?
Because it's not right for everyone. I think in life, you have to have an unfair competitive advantage. Unfair being the key to competitive advantage. And if you don't have an unfair competitive advantage to be in real estate, don't do real estate. Find something that you will have an unfair competitive advantage in and do that. Life is too short to play somebody else's game. You got to play your own game. So what separates, and that's God's honest truth as far as I'm concerned, is that in some way, shape, or form, we have an unfair competitive advantage. Mine was that I had MS. I didn't have any other options. So my advantage was it was either this or fail at life. His is that his relationship with numbers is such that just flat out gives him a unfair competitive advantage. So in my estimation, you have to know yourself and you have to not try to shove a square peg in a round hole. And if this is the right thing for you to do, you'll know it. You don't need me to tell you. You don't need Brandon to tell you. You'll know it. It has to be the right thing for you to do.
What do you think?
Consistency for me. Going back to when we first started, and that's that 6 months that we spent looking for deals, putting offers on deals, and just not giving up and not getting swayed and doing something else, just doing consistent and underwriting every day, putting offers on deals, and eventually you're going to break through.
Very good. All right, guys, we got to get out of here, but it's been fantastic. Thank you guys for joining me in the Sea Shed today out here in Maui. Now get to the beach.
Now we're going to go sit in the hot tub or the beach?
I don't know. Probably the beach. Where can people find out more about you guys?
Whitehavencapital.com.
Whitehavencapital.com.
Just ask benwhy.com.
All right. Thanks, everyone, for listening today. If you like today's show, make sure you leave a rating, review in iTunes, and share this video or podcast, depending on how you're watching or listening to this, with somebody you like. All right, that was our show with Ben and Sam, two wicked smart guys. But remember, as I said in the introduction, we are actually going to tack on an extra 45-minute show, give or take a little bit, here at the end. So right now we're going to it. And this was recorded after
or at least it was recorded the day after Mother's Day 2020. And so you're going to hear the first thing we just talked about for the last couple hours was really all about before the COVID thing really came down, social distancing came down. Now we're going to talk about a little bit about after. And again, just like before, there's some high level stuff here, but this stuff is super important. I want you guys to pull out the stuff, just the gold nuggets from this episode. And we'll kind of summarize at the end in case you get lost throughout it, because again, we are covering a lot and it's very high level. We'll summarize at the end a little bit all these important points that are going to change your real estate investing life forever. So without further ado, let's jump over to our second interview post crazy social distancing, or at least during, with Ben and Sam. All right, Ben and Sam, it's been a whole 6 seconds since we left you on the podcast, and we're coming back in for kind of an outro, a secondary outro. We got to have a better name for this. It's a reprisal. A reprise? Is that a name? Your kid's in theater, Ben. Isn't that what it's called when they come back on?
It's called a reprise.
Oh, a reprise.
Among us, intelligentsia, it's called a reprise.
Okay.
Now, you wouldn't know about intelligentsia. Okay.
I just go to my reprising, and we're going to talk about real estate right now. All right, fellas. So we had you on the show just a few minutes ago, but in reality, we recorded this obviously a couple months ago, right before as COVID social distancing was being enacted. In fact, you guys were staying next door to me here in Maui, and you came over. You trekked through the woods. You got to my sea shed. We recorded the episode, and then you went home, and you were the last person to stay in that house before they shut down all vacation rentals and the entire world went nuts. So we thought, let's talk to you guys about what's changed in the past couple months since this happened. I mean, we had a lot of conversation about what if and what could happen in the world, and then now we've seen what happened. So let's go through a little bit of, obviously we don't need to recap much because we just talked about it, but I'm curious, what have you guys seen in the past couple months in regards to your real estate properties?
So if you look at National Multi-Housing Council, every week they've been publishing rent trackers and showing what percentage of the country is paying their rent on time, and they're comparing that to this was starting in April, so they're comparing it to March, and then as well as last year, and we tracked pretty well ahead of that the entire time. I think a couple of our properties were at 99% end of the month at 99%, 98% collections. The lowest we had was 96% collections at one of our properties, and it was the most recent one we purchased, and we can talk about why that is. But we've seen pretty good collections, and actually May is doing a lot better than April. I think we're 15% ahead of where we were in April.
Here's what I find funny. I've seen a number of articles come out over the past couple months of all the tenants are not paying rent and this problem and in reality, everybody I've talked to has been fine. I don't think I've had anybody who's nobody's paying rent, it's not happening. So I do wonder a little bit about this whole, I wonder a bit about where these studies are coming from. Does that mean most of the landlords we associate with just know what they're doing, and it's they're being weighted down by people who just have no idea what they're doing?
You and I taught them. They ought to know what they're doing.
They ought to know what they're doing.
We've been at this for a decade.
Yeah,
crying out loud.
Yeah, we'll pat ourselves on the back. Clearly, that's why this is going well. Yeah, I find it funny. If we're all above average, that means there are a lot of people that are below average, and I don't know where those people are, but they must be out there somewhere. I don't know.
We're stuck in today, right? So let's give people credit, because there's a lot of pessimistic people, and a lot of people are saying, "Oh, there's trouble coming down the pike," and all that. So we need to separate those two conversations. The Fed has pumped, what is it, David? $5 trillion into the economy.
A couple trillion, right?
It's not surprising that collections are doing fine. The real question macroeconomically as it relates to real estate is going to be, how are those collections priced? In other words, what's going to happen to the market is a function of how investors value these collections. So your NOI stays the same or even does better. At Canyon 35, we now know that we collected, $82,000 in revenue in March, which was the highest March to date. It looks like about 85. We don't have those numbers yet, but somewhere between 84 and 85 in April. We're supposed to be down in April. April just set a new high at Canyon. That's a 98 unit property. It had 2 residents that didn't pay. We have South Mountain. We talked about South Mountain, 117 unit property. There was one resident that didn't pay. Now, this is fantastic. We can tap ourselves on the shoulder. Now, the people that have been around for a long time, though, understand that valuations are a function of how you premium the revenues. What are these revenues worth adjusted to risk? Because that's really the question and the conversation. When you buy an asset that is an income-producing asset, whether it be, a multifamily or a storage facility, or what you do, what's the revenue worth? How much am I willing to pay for that revenue? And a lot of the voices that you hear right now are people being very pessimistic in that investors are going to want to discount the validity of this revenue. Because why? Because Fed pumped in $5 trillion, because, the stimulus, because the unemployment, people are making more money on unemployment than when they work. And clearly we don't have visibility in that. But interestingly, if you're going to be logical about this, you as an investor who needs to deploy capital, you have choices to make. So it's not like real estate exists in like vacuum without anything else. What are you going to do? Bonds for your income? Are you going to go buy a business? Are you going to buy, what is it that you're going to buy? And so the very interesting conversation to me right now, the most interesting, because we already know what the operations look like. Operations are fine. We're fine. Okay. Now, I don't know what happens 6 months from now. Personally, I think Class A is going to take it on the chin, because right now they're fine. But 4 months down the road, when those cupcakes, their parents are telling them they're not going to pay for their fancy apartment in downtown while they play guitar in the bar around the corner, when that in Denver, when that happens, maybe the situation changes in Class A, but Class C already took it on the chin. The conversation around operations, we kind of already have it priced in. Like you said, you talk to everybody knows, and nationally they track it. The real question is, does that bring us to a standstill? Like, will Sam and I buy a property right now? Do we know how to underwrite a property going forward? Or do we need to sit and wait and see what the risk premium really is and price that in and understand how that looks?
So when you say risk premium, I think just to summarize a little bit, what we're talking about here is essentially, and you can correct me if I'm summarizing wrong, but essentially we're talking cap rates, right? So a cap rate is essentially a way of looking at how the market values income, right? That property makes a lot of income. That's more risky. That's less risky. I'm going to pay a higher cap or lower cap. My question then is, like, what do you think? I mean, do you think cap rates are then going up across the industry, or do you think they're going to stay where they're at?
I don't think they're going up. And even if they are going up, if you got 10 years, you can stay in the deal. You can, you don't have to sell when the cap rates go up. You can wait it out. You can cash flow the property and sell when the cap rates come down to where you need to come down. There's a clear disconnect right now. Buyers all think for some reason that they deserve a huge discount. None of the sellers who are cash flowing just fine, such as us, are even remotely willing to consider that type of a discount.
Can I jump in? We need to clarify a couple concepts. And when we talk about cap rate, it's basically an evaluation that's the metric that's used to determine how much a property is worth. And for purposes of this conversation, the lower the cap rate, the more a property is worth. So if cap rates are rising, in a sense, that means there is less demand for this product. And so the property itself becomes worth less. And when you're using a metric like that, Ben's argument is it's more or less a kind of a newbie way of looking at what a property is worth, because there's so many more metrics that go into it. But you do need to consider that when you're thinking about selling, because the person who's buying your property might look at that.
So cap rate is really, it measures demand. It really isn't a good investment return metric. It's just a demand metric. So generally speaking, people will be willing to deploy capital at higher price points if they feel safer in that marketplace. Maybe there's job growth. Maybe there's population growth. Maybe there's whatever. Maybe there's a supply-demand issue that suggests that long-term, price is going to stay. Whatever the reason is, that's why you have a market over here with a low cap rate, which means people are paying high dollars, and you have a market over there with a very high cap rate, which means people are paying lower amount for the same revenue stream.
Part of the point that you're making is that buyers are expecting cap rates to go up, so property should be worth less and they should get a deal. But sellers are saying, no, it's still worth the same to me because the cash flow hasn't actually stopped. I don't know what you're smoking. And we're in this weird dynamic right now where the market's sort of stalling because each side's expectations aren't being met.
Right. And so now you have these two camps of people who are buyers are like, well, we're going to just wait and see, until you guys, run into trouble. And us as sellers, I'm like, why should we run into trouble? We had April collections higher than March, and now May collections are on track to be just fine. And yeah, it's because of the Fed, and yeah, it may be artificial, but guess what? Fed's on my side. Do you really think in an election year there's not going to be another stimulus if my tenants can't pay rent? Do you really think that's going to happen? So, that enters into this whole another political conversation and everything else. So you have this environment where potentially buyers sit over here and sellers sit over there, and that goes on for 9 months, for all I know, through November, through the election and everything else.
So the question is, and I guess I like the way of looking at it this way, because David, you brought this exact point up a few weeks ago on the podcast about single family houses and small deals. The same thing applies here. Like, David, I think you said it was like prices won't drop like super fast because sellers are going to hang on to it because they still remember the good old days. And the buyers are all thinking immediately, this is 2008, let's get a 20% discount. And so what happens is there's this lag that happens.
There's another layer of this that I just realized maybe yesterday as I was going back and forth in my head with a lot of what Ben is talking about. And it has to do with a lot of the really successful, wealthy people that I know and that Brandon knows. I'm sure you guys know some of them too, that have been telling people, preserve capital, sit on the sidelines, wait for a good deal. And then the newbie, the amateur, the less successful person hears that and goes, oh, that if Warren Buffett's doing that, then I'm going to do that too, because I want to follow Warren Buffett. And I was kind of trying to reconcile all this in my mind because I'm not waiting for this huge crash before I would actually take action. But I also don't think that that's stupid. And I kind of think that the guys who were saying wait would agree with me if they looked at the deal. And what I realized is a lot of those people giving that advice are not in the same position as the guy who doesn't own a property or owns one or two, who is actually looking to work and manage and learn the business and make money on a deal. They are running companies and they want a completely passive investment. They don't need to invest in anything. They have plenty of income coming in. They are in no rush. They're happy to wait for the bottom. And if it takes 12 years, well, then they'll wait 12 years because if they go buy a property, that's work they necessarily don't want to do. The people listening to this podcast, they're looking for work. They want a property. They want a deal. They want something that cash flows. Yep. They want to learn the business. They want to plant a seed that will grow into a tree over the next 40 years that's going to be huge. And when you're listening to the guy who's worth $150 million and has other people managing his assets, he doesn't even do it himself. And he doesn't know, or she doesn't know, what's happening with that deal they buy. Their advice is going to be much different. They can pass up on 80 great or good deals to get one great one, because they don't want to be bothered from the other stuff they're doing. I can't pass up on 80 good deals at this stage in my career. If I see 80 good deals, I want to buy them. And that's an important thing to keep in mind when you hear that Twitter quote from Mark Cuban or somebody telling you, no, wait, it could crash more. I'm waiting, right? That doesn't mean that he's in the same position with his capital that people like us are that are actively looking to build our portfolios.
All right, so here's a question then. So in the way you're analyzing deals now, especially, like in what you're looking at, are you estimating, I guess, rents going up the same amount that you were before? Do you think rents are going to stay, or have you stopped, Sam, like your rent growth or your predictions there? Where are you at with that?
In our underwriting, we are not projecting rent growth for the next 2 years.
Okay.
I think that's very conservative. I think we will have rent growth. Phoenix is still supposed to have the top population growth in the country for this year. Likely going to continue next year. And construction has slowed down. So we're going to probably even see higher rent growth than what we were seeing before.
But just to be safe.
But to be safe, yeah. And investors, I mean, it's hard to have that in-depth conversation and justify it. Be conservative. Yeah, we've stopped for the first 2 years, no rent growth. But there's two different types of rent growth for us. We're still renovating properties and we're still seeing $400 increase in rents on the ones that we're renovating, where a lot of people, they're stopped renovations. Ben and I don't believe in that. We're actually delivering a different product through our renovations. And there's someone's willing to pay for completely different products. We get a different tenant in there that's willing to pay that. Whereas a lot of other type of renovations where you're just putting lipstick in there, light remodel, and you're just trying to squeeze more dollars out of the existing tenant, you're probably stopping right now. You're not going to get squeeze more dollars out of that existing tenant. But if I'm completely moving up a class of product and getting a different type of tenant in there, I'm still going to get that rent premium. There's still a difference between a B and a C class in rents.
Right. And that's become such a cliche. You know, we're going to buy Class C property and we're going to put some lipstick on that pig and we're going to make it into a Class B property. You know, guys, like property class is not exact science. So they look at the age of property, they look at the vintage, they also look at the amenity package, they also look at the unit layout. So a Class A property would be something that's not only new, but it's trendy. Okay? You can build Class A that's not really Class A.
Yeah, you can build low-income housing in Class A. I mean, like brand new. It doesn't mean it's nice.
Yeah.
Unless you are on the coast in New York or in San Francisco, where if you are overlooking the water, it doesn't matter if you're 150 years old, you're still Class A. In majority of the country, Class A is newer construction. So can you take a 1985 building, no matter what you do with it, you can put gold-plated toilets in it. Can you really intellectually, honestly call it Class B? When Class B could be 1998, which looks different. The layouts are different. The amenity packaging is very different, and you may not be able to replicate it or compete with it. So I see a lot of disingenuousness in all of this. What Sam and I do is at best we create a subclass. So we take a Class C property, and I wrote about this on the blog. We take a Class C property and we go into this location and we're saying to people basically, hey, we know it's not for all of you, but are there 90 of you, 160 of you in this 2-mile radius that have pulled yourself by the bootstraps and make that $50,000 a year, and you are willing to spend a few extra bucks to live nice? You would have done it already, but nobody came in to give you that product. But that's been our business plan, is because we're from the get-go, we're saying, hey, we're going to spend more than anybody else on improvements. We're going to create a subclass of product that tenants literally don't have any other choice. If they make enough money and they want something a little nicer, we are it. Everybody else is resurfacing the countertops and refacing the drawers. We're putting in brand new stuff with granite and stainless. Nobody else is doing it. We're it.
Just to make a point, this applies, by the way, just for people listening, not just to the big apartment complexes, but I found this in my single families, my duplexes. Like, I like to say that, and you guys heard me say it before probably, is C and D class tenants still watch Chip and Joanna Gaines. They still want that beautiful look. Nobody's giving it to them. In a lot of markets, like especially like B minus, C class, even D class, like those tenants can't find that thing, but like you go to Starbucks and you pay $5 for a cup of coffee. Why? Because of the experience and because of the ambiance and because the coffee is maybe good and it feels good in your hand. People are willing to pay a premium, even people who don't have a lot of money, for a premium. They're willing to pay a premium for a premium product. And so you guys are providing premium.
Class A within that ecosystem, right? So it's not real Class A, but it's Class A of that kind of that location.
I have this fourplex, this Rosie's fourplex. We got this thing. It had, average rents were like $425, $450, and up. I mean, they were all vacant except for one garbage hoarder, but like that's what they were getting. Their worth around $450, $500 maybe. Like nice $650, maybe I could push it to. I'm getting like $800 a month for each of the four. So even though it's in a pretty bad location, like I would not. It's the worst location of any property I own. Yet I'm getting like, upwards of $800 for it. Why? Because it's just a better product than anything else in that market. And there are people, I don't need all of them. This is the point you just made, Ben. I just need 90, or for me, I needed 5. I needed 4 or 5 people in that market who are willing to pay a premium to go to Starbucks instead of going to 7-Eleven for the coffee.
Right. And it's silly of us to assume that everybody wants to live like everybody else. Mm-hmm. If you grew up here and your grandparents live here and your kids go to school here, you want to stay here. You don't want to drive to that other part of town, no matter how nice it is, and then drive 57 minutes to get to work and pick your kids up at school and all of that. You just want something a little nicer. You got to be careful. You have to have the right product, the right unit mix, the right unit layout, the right amenity package, the right location. It's not as simple as you go buy a piece of shit in a piece of shit location and you can put granite in it and it's fantastic. It's not. That's the fastest way to lose money. So
the strategy, Ben, in this case is going to be look at your market and try to be the best option compared to what you have next to you. Don't just take this random blanket strategy of if I put in granite countertops, they will. If I build it, they will come, right? Which ties into your earlier point that not all revenue streams are the same. Because it's a very good point that you made. When you're buying investment property, what you're really doing at its base is buying a revenue stream. You don't really care how pretty it is or what it looks like, other than how those things will affect your NOI at the end of the day.
Correct.
And some revenue streams, for instance, hypothetically, a complex in Beverly Hills where 95% of your tenants are doctors who are never home versus Detroit at the peak of its misery. Those revenue streams are completely different. They require complete different amounts of work to maintain them. It's a completely different experience. So that's why, in theory, some cap rates are lower than others because the money comes easier in some places.
Right.
In last week's episode, we interviewed Josiah Smelser, and he went over how he had made like 10 BRRRR properties going on at one time. The bottom dropped out on financing, and he had a heck of a time and had to get really creative with how he was going to refinance them. Can you share, I think, your 118 unit building, how you guys are currently planning on refinancing that thing with, you're still getting rents coming in, but a lot of lenders at this time have sort of halted giving out loans. Has that been your experience?
We're refinancing into agency debt, so your Fannie and Freddie products. While their terms have changed, they're still lending. And you can still get mid 75% LTV. They're making you come in with extra reserves. So now between 9 and 12 months of mortgage payments, you have to have on hand at closing that they hold in escrow basically. And so we already had that. So that doesn't really affect us too much. That's how we underwrite. And I think we talked about that 2 months ago when we were recording. So it didn't affect us too much, but into the refinance, so you just have to have a little bit extra reserves on the refinance. But you can still get great product. I think float rates are still all-time lows on Fannie Freddie. So it's a great time to refinance, even with that extra reserves.
If I could add a couple of points, that's not a small thing. If you are used to going into a closing with 2 months of interest reserves, and now all of a sudden you have to have 9 or 12, it's not a small thing. On a $4 million, $6 million raise for an acquisition, you could be $700,000 off, which will drastically change your projections on returns, which is why deals fell out of escrow. Now, it doesn't have an impact on us because I am a neurotic Jew, afraid of everything. And I want reserves, and we've always had 9 months of reserves. And that's just how it is, and I won't close a deal without it. So nothing has had to change in our underwriting to accommodate this.
So for the deal you guys currently have on the market, what's the plan with that?
So it's still on the market, but we are moving forward with the refinance on that one. I'm going to put long-term debt on it. And actually, our debt service will go down quite a bit. We'll have an extra $10,000 a month in cash flow. It looks like from refinancing.
Which actually brings us to a very interesting conversation about exit plans. Like how in every deal, the way you need to underwrite. And so you have option A, option B, option C, option D. So typically we would wait. We would either sell it as a proven value add, which is what we try to do. We put it on the market to show them, listen, we started with $58,000 of revenue. Now we're at $85,000 of revenue with half of the units renovated. Do you want to buy this thing and finish the project? We've proven it to you. All you got to do is finish it. Take it and finish it. So we're going to sell it to you for less than we would if it was fully complete because we didn't complete it. So we're going to split the profits with you. So that was the business kind of plan to try to exit early. But if you don't exit early, you finish it and you sell it as a turnkey. And if you don't...
We didn't underwrite that early exit. That was very opportunistic.
Correct.
The market was hot. People really wanted a product. And we said, sure, if you're willing to pay still under a 4.5 cap for our revenue, take it.
How has that changed, Sam, since COVID? I mean, what do you expect? Put on your crystal ball. Like, do you think?
Well, like we talked about earlier, everybody's just so far apart, right?
Yeah. So, do you think it's just probably shot at this point?
So a lot of people are just waiting for the good news, right? It's a little bit less uncertainty out there.
Yeah.
So I think May numbers, a lot of people are waiting on May numbers, and we just started getting them right before the weekend. I think a couple weeks from now, you could, if this keeps continuing and you still get good news on the pandemic side, I think you could still see an exit. So we still might have a chance of selling before we do the refinance. But once we have April numbers here in about a week, we're going to move forward with the refinance. If we sell it before then, that's fine. But the kind of debt we're putting onto it, there's no big, large prepayment penalty. So I can still sell it a year from now and get the exit. It's not like I need to hold on to it for a long time now, even though we're refinancing it.
It's just option A, option B, option C. Right now, this money might as well be free. I mean, it's 3.2%. Last quote I saw was 3.2% from Freddie Mac. I mean, it might as well be zero.
I want to summarize everything we just talked about in the last 45 minutes in a couple quick points, and then I'm going to ask you guys your final advice for people right now that are listening. But first thing, number one, rents seem to be fine. That's good. I mean, I'm seeing the same thing. David's seeing the same thing. Rents seem to be fine. Second point is when you have, and this is kind of like summarize everything else we said, when you buy a good deal and when you have adequate reserves, you can do what you guys are doing, which is weather storms. Because you have the reserves, you had a good deal going into it, you had a plan, and you're still working the plan. And so like this applies to anybody, whether you're buying a first house, a 100 unit, or anything in between, is underwrite deals well, be conservative, and have reserves, and you're going to be fine. A good summary of that, of why you guys are doing okay through all this?
Yep, exactly.
That's exactly it.
We can throw in cap rates can be misleading. They're a metric that you can't necessarily lean on. I like to look at them like a 40-yard dash time of a player that you're looking to bring into the NFL. It's a good starting point. Oh, that person's fast. Let's look at this one. But you would never draft a player just because they have the best 40-yard dash.
Good analogy.
Right? Thank you. There's a hack that can be found if you use Class A principles in Class C and B properties. That might be a good way to sum it up. It doesn't have to be Class A money that you're throwing at it, but if you can make your property the Class A of its area, you may attract the cream of the crop people, give yourself an easier revenue stream to manufacture as well as a higher revenue stream when everybody else is kind of marching to the same drum. That's another thing that we talked about. And the whole, well, what if this happens? What if there's a black swan event? I don't want to own real estate. Like you mentioned, Brandon, then you just keep collecting rent and you refinance and you make money that way, or you run your property better. And at a certain point, you can get out of it. And so there's a lot of similarities between this story and Josiah's that we did last week, where the worst case scenario in some cases happened, or at least we were prepared for it. And it wasn't that bad. Rents actually didn't stop coming in. Now, if we had a shelter in place for another 7 months in a row, I'm sure this would be a different story. But as Ben pointed out, the government, while they cut us open and we started to bleed, they then came in and gave us a blood transfusion more or less at the same time. So people were getting money. There's a stimulus package that was prevented. It's not as good as if we kept working, but it's certainly a lot better than we bled out in 3 months and the entire economy went into a depression because of it. That isn't what happened. And so for the people that were running around screaming, the sky's falling, keep this in mind the next time that there's a big problem. Don't let your fears get ahead of the facts. Okay, I think that this could happen, so I'm going to assume it's going to happen, and stick to the fundamentals. You have strong reserves. You're in a really good market. You understand what you're doing. You don't have to get in and get out in 5 years, where you have one way to hit the bullseye, and if you miss it, you're going to lose money. And real estate is freaking awesome. You know, people who bought stocks can't really say the same thing as us talking on this podcast.
Think about how much control we have. I mean, we've been talking about doing X, Y, and Z and being proactive, and that gives us control, so much control to respond to even a black swan event such as this. I mean,
really good point. So Sam, final point from you then. What would you leave people with?
2 points. So reserves and cash flow, they allow you to exit when you want to exit, not when the market tells you how to exit.
Yep.
So I'd always go in with a lot of extra reserves, especially if you're low on cash flow at the beginning. And then the second point, and it basically approves what you just said, the properties that we've had most renovations completed, so we're over 50% of the property renovated, had the highest collections the last 2 months. And even if they were in a worse location, and we're not surprised by that at all. That was our assumption going in, and it just was validated over the last 2 months.
Good deal, guys. Well, we don't need to do the famous 4 or 5 round or any of that because we already did it. People can listen back if for some reason they skipped that part. But with that, we'll just get out of here. David Green, you want to close up shop?
Yeah, thank you guys very much for coming on. Sam, I feel like you probably could have made your points a lot quicker and you just droned on and on and on the entire episode. Hopefully we can edit you down a little bit because you're, the ball hog of this podcast for sure. But, thank you for coming as it is.
Hey,
and
guys, he's talking to me. You guys listening? This is like a very thinly veiled.
And yet you still took the mic from him.
And
yes, that's the hilarious part of it. That's the hilarious part of it. You fell right in my trap there, Ben. All right, guys, thank you very much. It's not always fun coming on to talk about when things go wrong, and I appreciate you doing that. And we got a lot of very, very good and interesting stuff out of this.
Yeah, thank you.
Thanks.
Thanks, guys.
You're listening to BiggerPockets Radio, simplifying real estate for investors large and small. If you're here looking to learn about real estate investing without all the hype, you're in the right place. Stay tuned and be sure to join the millions of others who have benefited from BiggerPockets.com, your home for real estate investing online.